Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're going to talk about a true legend, Philip A. Fisher and his masterpiece, Common Stocks and Uncommon Profits. This isn't just one of the most important investment books ever written, it's a whole philosophy. And we're going to look at it through a really special lens, the eyes of his son, the equally famous investor, Kenneth Fisher. He gives us this incredible inside look at the man behind the method. You know, to really get Fisher's work, you have to appreciate this one story. His son, Ken, read the book for the first time when he was just 8 years old. And his reaction? He said it made darned little sense. And that's not just a cute story, it's kind of the whole point. Fisher's philosophy isn't some get-rich-quick scheme. It's a deep, serious craft. It's something that takes years to really sink in, but once it does, well, it can change everything for an investor. So, here's how we're going to tackle this. First, we'll get to know the man himself through his son's perspective. Then, we dive into his secret weapon, a little thing called Scuttlebutt. After that, we'll unpack his famous 15-point blueprint for finding truly amazing companies, cover his 10 big rules for how to actually behave as an investor, and finally, we'll look at the incredible legacy he left behind. Let's start with the man himself, because you can't really get the method until you get the man. And believe me, Philip Fisher was anything but your typical conventional thinker. His son paints this picture of a brilliant but really complex guy whose personality was the very secret to his genius. So what was this guy actually like? Well, he definitely wasn't the life of the party. His son called him a non-linear genius, which is a great way of saying his brain just didn't work like other people's. He was socially awkward, preferred to be alone, and was a total creature of habit. But here's the key. That wasn't a weakness. It was his superpower. It's what allowed him to tune out all the noise and think for himself, to completely avoid the herd mentality that gets so many investors into trouble. And his career was just epic. He was literally in the first ever graduating class of the Stanford Business School, and then, get this, he starts his own investment firm in 1931, right after the crash of '29. I mean, talk about guts. And he didn't just survive, he built a legendary 72-year career by just sticking to his guns, and in 1958, he gave us all the blueprint in his book. His son boils his dad's entire life down to 3 simple things. He calls them the 3 W's: walking, worrying, and work. The man was a ferocious walker, just burning off nervous energy. And he was a professional worrier. Now that sounds bad, right? But for him, worrying was a tool. It was his risk management system. He figured if he could worry about every possible thing that could go wrong, he could avoid making stupid mistakes. And then, of course, there was the work, where he put that unique brain to the test. All right, let's get into the heart of his method, the thing he is most famous for. The word itself sounds a little goofy, but Scuttlebutt was Philip Fisher's secret weapon. It was how he found out what was really going on inside a company, the kind of stuff you'll never, ever find in an annual report. So what the heck is Scuttlebutt? It's actually pretty simple, but it's incredibly powerful. Think of it like being an investigative journalist, a detective for your investments. It means you don't just sit there reading reports. You get out and you talk to the people who actually know what's up. The company's customers, their suppliers, their former employees, and especially their competitors. It's about getting the real story from Main Street, not the hype from Wall Street. And that's the fundamental difference right there. On one side, you have real boots-on-the-ground information. You talk to a competitor sales guy, and believe me, he'll give you the unvarnished truth about your company's product. On the other side, you have what Ken Fisher calls Wall Street malarkey. It's just noise, gossip, rumors, hype, all designed to get you to buy or sell something. Fisher chose verification over malarkey every single time. And if you think this is all just some quaint, old-fashioned idea, think again. Look at this quote from Ken Fisher. He says, "The huge blow-ups, the Enrons and WorldComs of the world were easily avoidable. How? Because if you'd done your scuttlebutt, you would have found out there was no there there. The competitors weren't scared of them, the customers weren't impressed. The real story was on Main Street, plain as day, while Wall Street was still writing glowing reports." Okay, so you're doing your scuttlebutt, you're out there being a detective, but what are you actually looking for? Well, Fisher laid it all out in his 15-point blueprint. And I've got to warn you, this is not a simple checklist where you just tick off the boxes. It's a whole framework for thinking about what makes a company truly great for the long haul. So here's the most important thing to get about these 15 points. They are all about the future. This is not about what a company did last quarter. It's about whether they have the potential to grow and dominate for the next 10, 20 years. You're looking for this rare combination of a huge market, amazing innovation, a killer sales team, and, this is the big one, managers you can trust completely. Now, 15 points is a lot to remember, right? So let's kind of group them into 4 big buckets. First, futuristic potential. Is there a giant runway ahead for this company? Second, can they actually get it done? Do they have great R&D, and can their sales force actually sell the stuff? Third, the boring but important stuff. Is the business profitable? Do they watch their costs? And finally, the foundation for everything else, integrity. Can you trust the people running the show? I absolutely love the dedication in his book. It pretty much sums up the entire mindset you need. It's basically saying, hey, if you're the kind of person who just wants to believe what you want to believe and you don't want to be bothered by the actual facts, this book is not for you. It's a direct challenge. It's for people who are willing to do the hard work and let the facts guide them, not their gut feelings. All right, moving on. We know what to look for in a company. But look, finding a great stock is only half the battle. Not messing it up is the other half, and that's all about psychology. So Fisher also gave us some clear rules on how to behave as an investor. Let's run through some of his big don'ts. And these are just as true today as they were 60 years ago. Don't buy into promotional companies. The ones that are all sizzle and no steak. Don't follow the crowd. That's investing 101. And this one's interesting. He said don't overstress diversification. He'd rather you own a few great companies you know inside and out than 100 you barely know at all. Sound familiar? That's a lesson Warren Buffett clearly took to heart. And here's a great story that just shows you how well this guy understood people and psychology. So he's at this conference, right? And they have this little contest for the audience. Write down your prediction for what the Dow Jones Industrial Average is going to do tomorrow. Now, Fisher knew this was a total fool's errand, a guessing game. But he saw a chance to play a different game entirely. So while everybody else is writing down these safe, small numbers, up 2 points, down 3 points, whatever, Fisher writes down this totally audacious number, up 30 points. Just a huge, crazy move. And his logic was just brilliant. He thought, if I'm wrong, who cares? No one will remember. If I'm right with a small number, people will just say it was luck. But if, by some 1 in a million chance I'm right with a huge specific number, they'll think I'm a genius. And you're not going to believe what happened next. The Dow Jones skyrockets. 26 points, Phil Fisher wins the contest. The crowd went nuts. They thought he was some kind of wizard who could see the future. But it had nothing to do with predicting the market. It was a calculated bet on human psychology. It was pure showmanship and a fantastic lesson in how much perception really matters in the world of finance. So let's bring it all home and talk about his legacy. Because the impact of this solitary, nonlinear genius goes so much deeper than just the money he made. He fundamentally changed how smart people think about investing. Period. I mean, just look at the ripple effect. His book becomes required reading at Stanford, shaping thousands of future business leaders. You've got Warren Buffett, who famously said his own style is 85% Graham and 15% Fisher. Fisher is the one who taught Buffett to stop looking for just cheap companies and start looking for wonderful companies. He was really the guy who pioneered this whole idea of growth investing and finding a long-term competitive advantage. But maybe the most powerful insight into his genius comes from his son. He said his dad's real gift was being a mirror. Think about that. He said brilliant people would come talk to his father, and they'd leave seeing their own ideas with brand new clarity. He didn't just give answers. He asked the kinds of questions that unlocked deeper thinking in other people. His true gift was making others even smarter. And that brings me to one final story that just nails it. The legendary editor of Forbes magazine, a guy named James Michaels, spent a few hours with an elderly Philip Fisher. And for the entire car ride after, he kept pestering Ken Fisher, saying, what was that one question he asked? I can't quite remember it, but Jim knew it was the key to everything. And then Michaels remembered it. And this single question, this just sums up the entire Fisher philosophy. It's so simple and so cunning. What are you doing that your competitors aren't doing yet? See? That one little word at the end, yet, that's the whole secret. It's not about what you're doing now. It's about what's in the pipeline. It's about innovation. It's about constantly looking to the future. It's about finding the companies that are building the world their competitors will have to live in tomorrow. It's a question every investor and every leader should probably never, ever stop asking. Welcome, everyone. Let's be honest, we all want to make our money work for us, but the path to doing that, it isn't always so clear, is it? So today, we're going to dig into some timeless wisdom from one of the true greats, Philip Fisher, and see how his clues from the past can actually give us a much better map for our own financial future. Okay, so here's our game plan for this explainer. First, we'll talk about why we're all drawn to the market in the first place. Then we're going to look at two completely different ways people try to get rich. After that, we'll unpack a really interesting idea that our opportunities today might be even better than in the past. We'll also blow up the whole idea of a safe investment, and then we'll wrap it all up with a super practical checklist for how to spot a great company. You know, at the end of the day, the reason we invest is pretty simple, right? We're all trying to make money. Maybe you're looking for that next big thing, that revolutionary company, or maybe you're just trying to keep your savings from getting eaten alive by inflation. Whatever your personal goal, it all comes down to profit. But here's the kicker. The most obvious way to get there is almost never the best one. I mean, this is the question, isn't it? It's the one every single person who puts $1 in the market asks themselves. Everybody's got a theory, but what Philip Fisher found was that history gives us a very clear, and for a lot of people, a really surprising answer. This slide, this really gets to the core of it all. On one side, you've got what most people think investing is all about. This high-stress classic gamble of trying to time the market, you know, that whole dance of buying low and selling high. But what Fisher discovered was that the really big money, the life-changing fortunes, they weren't made on that roller coaster. They were built in a completely different way, by finding truly great companies and just holding on. All right, so let's really break down these two paths. Fisher talks about two fundamentally different ways to try and build wealth. And you've got to get this distinction because it's the foundation for his entire way of thinking. So, picture this. Go way back to the 19th and early 20th centuries. The economy was all over the place. And yeah, you could absolutely make a killing by betting on those wild swings, the booms and the busts. But, and this is the important part, even back then, Fisher found that another method was already proving to be way more powerful. Finding an exceptional company and just having the discipline to stick with it through all the noise. And this quote just says it all, doesn't it? The secret wasn't being some kind of market wizard who could predict every little dip and rip. Nope. It was about being a great judge of a business and, maybe even more importantly, having the guts to stay put through thick and thin. That simple act of patience, when applied to the right company, just crushed the frantic, stressful alternative. Okay, now this is where things get really interesting. Fisher didn't just stop at saying his way was better. He made a much bolder claim, that the world was actually changing in ways that made his strategy even more powerful over time. And these were changes that most people weren't even paying attention to. He pointed to three massive, and I mean massive shifts that were happening. These three pillars basically created this incredibly fertile ground for long-term investors. Let's walk through each one because you'll see how their echoes are still shaping our world today. First up, how companies were run just completely changed. They went from being, some founding family's personal property to these professionally managed machines. And that meant a constant hunt for the best people and the best ideas, all aimed at one thing, creating sustainable growth. For an investor, this was a huge deal. It meant more reliability and a focus on the long game. All right, pillar number 2 was an absolute monster, the explosion of corporate research and development, or R&D. So in 1953, Fisher points out that U.S. companies were already spending a whopping $3.7 billion on it. Now, that was a ton of money back then, but it was barely the warm-up act. Because then, get this, in just 4 years, by 1957, that number had almost doubled to an unbelievable $7.3 billion. I mean, just think about that pace. This wasn't just slow and steady growth. This was a rocket launch for innovation. And what does that explosive growth mean for an investor? It means new products, new markets, even whole new industries were just popping up out of nowhere faster than ever before. If you could spot the companies leading that charge, man, it was a genuine gold rush. And the third big piece of the puzzle was government. See, after the Great Depression, the whole playbook changed. There was this new understanding that the government should step in to prevent those kinds of catastrophic collapses from happening again. This created a kind of economic safety net, which made investors a lot more confident about holding on to great companies, even when the economy hit a rough patch. So when you put all this together, this new world of growth, and yes, a little bit of steady inflation, it had a huge impact on what people had always considered the safest place to park their money: bonds. To really get this, we have to talk about something called real return. It's actually a pretty simple idea. It's not about the number on your account statement. It's about what your money can actually buy. It's your true purchasing power after that silent little tax called inflation has taken its bite. That's the only number that really matters. And wow, when you look at the actual numbers from back then, it's a real shocker. So let's take the 10 years right after World War II. A super safe US government bond paid you about 2.19% a year. Seems okay, right? But during that exact same time, inflation was running at 3.4%. You do the math. That's a negative return. Let that sink in for a second. The safest investment you could possibly make was actually a guaranteed way to lose purchasing power year after year. Your money was in a vault, sure, but that vault had a hole in the bottom, and you were losing over 1% of your real wealth every single year just by playing it safe.
So, if trying to time the market is a fool's errand, and hiding out in bonds is a leaky bucket, what the heck are we supposed to do? Where are we supposed to look? Well, this is where Fisher gives us something incredibly practical: a checklist. And here it is. This is the whole thing, boiled down into 5 key clues. Is the company growing faster than its rivals? Is the management team both visionary and, actually good at their jobs? Is their R&D actually leading to profitable new products? And are they excellent at all the little day-to-day things? The key here is you're not looking for a company that checks 1 or 2 of these boxes. You're looking for one that has the whole package. And that brings us to the final and most important question. Fisher gave us this framework over 60 years ago. The world is a completely different place now. And yet, when you look at these core ideas, visionary leadership, relentless innovation, operational excellence, don't those feel more important today than ever before? So the real challenge this leaves for all of us is, can we take this timeless wisdom from the past to find the truly uncommon companies that are going to define our future? You ever see a stock just take off and you think to yourself, how on earth did they know? What really separates a lucky bet from a truly brilliant investment? Well, I'll tell you, it's usually not some complex formula or a hot insider tip. Today, we're diving into a powerful, almost detective-like technique from the investing legend Philip Fisher. He called it Scuttlebutt, and it's all about peeling back the layers of corporate PR to find out what's really going on inside a company. So, here's our game plan. We'll kick things off by talking about the challenge of finding those truly great companies. Then we'll look at an approach that seems obvious but almost never works. After that, we'll get into the main event, Fisher's Scuttlebutt method, what it is, how to build your own intelligence network, the rules you absolutely have to follow, and finally, how it all helps you see the clear picture. All right, first things first. Before we can even talk about a solution, we have to get our heads around the real problem. What's the fundamental challenge that every single one of us is up against when we're searching for greatness in the market? This is the million-dollar question, isn't it? I mean, it's easy to say, I want to invest in great businesses. Of course you do. But it is a completely different ballgame to actually pinpoint the specific company that has the right stuff for massive long-term growth. This is the exact puzzle that drove an investing giant like Philip Fisher. Okay, so before we get to Fisher's brilliant solution, let's take a look at the road most people would probably think of taking first. On the surface, it sounds super logical, really thorough, almost foolproof. But as you're about to see, for pretty much all of us, it's a dead end. So here's the obvious idea. You go out and hire a top-flight management consultant, someone who's run huge companies, to go inside the business you're looking at. They do a full audit of everything: the people, the production lines, the sales force, the research labs, and then come back to you with a simple verdict. Sounds pretty great, right? And here is where that fantastic idea just completely falls apart. First off, the number of people who can actually do this kind of deep dive analysis is tiny. And the ones who can, well, they're a little busy running their own multi-billion-dollar companies. But okay, let's say you could find and afford one. You'd still slam into a final, unbreakable wall. No promising growth company is ever going to hand over its secret sauce, its most sensitive data, to an outsider. It's just way too risky for them. So, if a direct front door investigation is totally off the table, what's left? This is where we get to the absolute heart of our explainer today. This is Fisher's genius alternative, the Scuttlebutt method.
So, what in the world is Scuttlebutt? I know, the name sounds a little like old-fashioned gossip around the office water cooler, but Fisher turned it into this systematic, investigative process. It's about building a complete 360-degree view of a company, not by talking to the CEO, but by talking to everyone around the company, its competitors, its customers, its suppliers. You basically become an intelligence agent for your own investments. And this quote just captures the whole idea perfectly. Fisher knew that this informal network of conversations, the business grapevine, is an unbelievably powerful source of truth. It's where you hear what people really think, far, far away from the polished press releases and carefully scripted executive interviews. Now, I know what you might be thinking. Okay, this sounds great, but come on, I'm not a full-time analyst with a giant Rolodex. How could I possibly do this? And you're right to ask that. Fisher saw this skepticism coming a mile away. It sounds like a ton of work, and for a lot of people, it is. And here's Fisher's really crucial answer. The point is, even if you don't personally make dozens of phone calls, just understanding how the method works completely changes you as an investor. You learn what questions to ask, you can evaluate the advice you get from a financial pro much more intelligently, and you might even start to realize, hey, I have some valuable insights from my own job that I can use.
Okay, so the theory is solid, but where do you actually find all this information? How do you build this so-called intelligence network from the ground up? Let's break it down source by source.
Our first source is one of the most powerful and, frankly, one of the most clever, a company's own competitors. Fisher's insight here was just brilliant. He said if you go to, say, 5 different companies in the same industry, and you ask each one smart questions about the strengths and weaknesses of the other 4, something amazing happens. He found that 9 times out of 10, a surprisingly detailed and accurate picture of all 5 companies just starts to emerge from all that commentary.
Next up, you've got the customers and the vendors. I mean, think about it. Who has a better grip on a company's real-world efficiency, its product quality, or the character of its sales team than the people who have to deal with them every single day? They see the reality behind all the marketing fluff. Now, here's a source that a lot of people might just completely overlook. If a company is bragging about some revolutionary new technology, who better to ask about it than independent experts? Researchers at universities, government labs, or even in competing companies. They can tell you if this new tech is a real game changer or if it's just a small improvement dressed up in fancy marketing language. And don't forget the executives at industry trade associations. These folks have a unique bird's-eye view of the whole landscape. They see the big trends, they hear all the chatter from the major players, and they can give you that broad, industry-wide context that is so important for making a smart decision. And finally, we get to one of the most powerful but also potentially trickiest sources of information: former employees. These people have seen it all from the inside. They know the real company culture, its true strengths, and all of its hidden weaknesses. But you've got to handle this one with care. So, how do you handle this source carefully? Well, the key here is judgment. A former employee will often talk very freely, which is great, that's what you want. But you have to really dig into why they left. Were they fired for not doing their job, or did they quit because of a serious ethical issue? Your job is to figure out their potential bias, account for it, and, this is the most important part, verify everything they tell you with other more neutral sources. So, you've got your list of sources. You're ready to start digging. But before any of this can work, Fisher laid out 2 foundational rules. And these aren't just suggestions. They are the absolute, non-negotiable price of admission to get good information. This, right here, is the bedrock of the entire method. Number 1, you have to make it crystal clear to your source that their identity will be protected and they will never be quoted. Number 2, and this is everything, you have to scrupulously live up to that promise. If people think they might get in trouble, they will never, ever share the negative but absolutely critical opinions you need to hear. Without total trust, the grapevine dries up and the whole method just fails. So, after all this digging, all these conversations, what's the end result? What's the big payoff for all this detective work? This quote from Fisher really says it all. You're not going to find that every single piece of information lines up perfectly with every other piece. That's just not how the real world works. But what does happen is a dominant pattern starts to form. The preponderant information, as he puts it, becomes crystal clear. all the market noise just fades into the background, and a really strong signal emerges showing you which companies are truly outstanding and which ones aren't. So, Scuttlebutt isn't the final answer, but it's the absolutely essential first step. Once this clear picture has started to form from your investigation, then you're ready for the next move. Now you can contact the company's officers directly, but you won't be asking them generic, fluffy questions. You'll be going in armed with specific, informed questions designed to fill in those last few gaps in your understanding. And really, that's the ultimate lesson of the Scuttlebutt method. The most valuable investment intelligence isn't always hidden away in a dense financial statement. A lot of the time, it's just woven into the conversations happening all around us every single day. It's in our professional networks, it's among our contacts. The clues are out there. The only question is, are you listening?
You know, we're all searching for it. That one investment, the one that doesn't just inch up, but truly multiplies your money. A company that creates real lasting wealth. But finding it, it can feel like searching for a needle in a haystack. Well, today we're going to put on our detective hats. We're going to use the wisdom of the legendary Philip Fisher and his 15-point investigation to guide us in uncovering these incredibly rare opportunities.
So this really is the central question, isn't it? It's the quest every single serious investor is on. And Philip Fisher, he argued that the answer isn't about timing the market or chasing the latest hot tip. Nope, it's found by asking the right questions, by doing the real legwork, and by genuinely understanding what makes a business truly exceptional.
And that's the core idea here. We're not just running down a checklist, we are building a case. Fisher's 15 points are a set of clues. Clues about a company's products, its people, and of course, its profits. So think of yourself as an investment detective, piecing together all the evidence to see if a company really has what it takes for that spectacular long-term success we're all after.
Okay, let's really dig into this, because Fisher makes a brilliant distinction. Some companies, like Alcoa back in its early days, they are fortunate and able. They happen to be in a fantastic growing industry and they have the skill to ride that wave. That's great. But the truly special ones, they are fortunate because they are able. Think about DuPont. They didn't start in the nylon business. They were in blasting powder. They literally created their own fortune through relentless innovation. This second group, that's where the real magic happens.
All right, our investigation begins. In this first file, we're looking at the most fundamental evidence, the business itself. What does it actually sell? Where is it headed? And what's the real engine driving its growth? This is the company's blueprint for the future.
So, our investigation kicks off with these 4 critical points. First, we're looking for a company with products that can drive sales for years and years, not just for a single boom cycle. But even more than that, we need to see a management team with a relentless drive to find the next big thing, powered by truly effective R&D and a world-class sales team to get it out to the world.
And this right here perfectly illustrates that first point. Just look at Motorola. They started out strong with TVs, but they didn't just sit back when that market got crowded. No way. They used their expertise to pivot into two-way radios for commercial fleets, then into semiconductors. They didn't just have one growth spurt, they engineered a whole series of them by constantly evolving. Now that is the sign of a true long-term grower.
This quote it gets right to the heart of it. Having great products today, like those Motorola TVs, that's only half the battle. Fisher's second point hones in on the attitude of the management. Are they dead set on making their own successful products obsolete before a competitor does? That forward-looking, almost paranoid mindset is the engine that ensures growth continues, not just for a few years, but for decades. Now, when it comes to figuring out if a company's R&D is any good, Fisher's insight is pure gold. He warns that the budget figure itself tells you very little. Some companies, he says, get twice the bang for their buck, and the real question is, why? Well, it's because their research teams work hand in glove with the folks in production and sales. They design products that can actually be built efficiently and the customers actually want to buy. And maybe most importantly, the big bosses get it. They understand R&D needs consistent, steady support, not these disruptive, panic-driven crash programs.
All right, time to open up our second file. We've investigated the what, now we need to look at the who. This is where Fisher's detective work really comes alive, because he focuses on clues that most investors completely ignore: the people, the culture, and the integrity of the whole organization.
Now, you're not going to find these things in a quarterly report. You uncover them through what Fisher famously called the Scuttlebutt method, actually talking to employees, competitors, and customers. Is this a place where people really love to work? Do they have a deep bench of executive talent ready to step up? And maybe most importantly, is this a management team you can actually trust? This is exactly the kind of thing you're listening for. When employees feel valued and respected, guess what? Productivity goes through the roof and turnover plummets. A company that pays its people well but still earns above-average profits? That is a huge, powerful sign. It's a clue that they're not just squeezing their workers for a short-term buck, but building a loyal, efficient team for the long haul.
This brings us to a critical question of sustainability. We've all seen those companies run by a single, brilliant, larger-than-life leader. But what happens when that leader's gone? A truly great investment needs management depth, and that's built when leaders are willing to delegate real authority, letting that next generation of executives grow and develop their skills. A company that can't grow beyond one person's capacity is eventually going to hit a very hard ceiling.
And this brings us to what is, for Fisher, the ultimate, non-negotiable deal breaker: integrity. These are not minor issues. These are giant flashing red flags that tell you the management team sees the company as their own personal piggy bank, not a trust they manage for you, the shareholders. If you find any hint of this, Fisher's advice is crystal clear. Walk away. Don't even think about it, no matter how good the other 14 points look.
So, great products and great people are absolutely essential, but the investigation is not complete until we look at the financial evidence. The ultimate question is this: can the company actually translate all that potential into cold, hard profit? Let's open our third and final file and take a look at the engine room.
This is what we are looking for right here. The best long-term investments are rarely the companies just scraping by. They are the leaders, the ones who consistently squeeze more profit out of every single dollar of sales than their competitors. A high profit margin is a sign of efficiency, a strong competitive advantage, a superior product. And you know what? Often it's a mix of all three.
But this raises a key question. How does a company keep those high margins? I mean, any business can raise prices when things are going well, but that's just a temporary fix. The truly great ones, they are absolutely relentless about improving efficiency. They invest in better equipment, they streamline their processes, they innovate on the factory floor. They build a durable cost advantage that lasts, even when they can't just hike up prices.
Okay, let's talk about this, because it's a sneaky trap that a lot of investors fall into. A company might be growing like a weed, but if it has to constantly sell new shares of stock just to fund that growth, your piece of the pie gets smaller and smaller. It's called equity dilution. So, the company's total earnings might be going up, but your earnings per share can get totally stuck in the mud. The best companies can fund most of their growth with their own profits and a bit of smart borrowing. So, we've gathered the evidence, we've examined the business blueprint, we've looked into the people factor, and we've analyzed the profit engine. Now it's time to render a verdict. Let's tie it all together with the single most important mindset that separates the truly great investors from the rest of the crowd. This quote, this gets to the very soul of Fisher's philosophy. Are you investing in a company that's sprinting, trying to squeeze every last penny out of this quarter's earnings, no matter the cost? Or are you investing in a marathon runner, a company willing to make investments and sacrifices today, like treating their customers and suppliers exceptionally well, to build a much stronger, more profitable business for the years and decades to come? And this is what our complete investigation file should look like in the end. A truly uncommon investment stands on these three pillars. It's not enough to have one or two. You need a great business model, run by great people, that produces great, sustainable profits. When you finally find a company that checks all of these boxes, you know you found something truly special. So I'll leave you with this thought. Everyone else out there is chasing headlines, algorithms, and quarterly earnings reports. By stepping back and taking on the role of the patient, thorough investigator that Fisher lays out, you're looking for clues that other people are completely missing. And maybe, just maybe, in that discipline, in that patience, lies the true secret to uncommon profits.
Welcome to The Explainer. You know, what if I told you that the secret to making a fortune in the stock market has almost nothing to do with being a math whiz and everything to do with being a great detective? Well, today we are diving deep into a classic, Philip Fisher's Common Stocks and Uncommon Profits, to really break down a completely different, and I think, much more powerful way to think about investing.
So here's what we're going to cover. First, we're going to absolutely demolish the myth of the investment wizard. Then, we'll get into the main event, a showdown between bargain hunting and growth investing. After that, we'll see what a real investor's work actually looks like. Hint, it's not what you think. We'll tackle that huge question. Should you do it yourself or hire a pro? And finally, we'll look at the incredible long-term payoff that makes this whole approach so powerful.
All right, let's jump right in with the investment wizard myth, because we have to get this out of the way first. It's this popular idea of what a great investor looks like, and according to Fisher, it is a deeply, deeply dangerous stereotype.
Seriously, just for a second, close your eyes. When I say stock market genius, what image pops into your head? I bet it's some lone wolf, right? Surrounded by a wall of blinking screens, talking in some kind of secret code about alphas and betas.
This is the picture we all have, isn't it? The quiet, bookish type, just buried under mountains of financial reports, searching for some tiny clue hidden in a footnote. They live and breathe this stuff. Their whole world is a spreadsheet.
And here is the big twist. According to an absolute legend like Fisher, that picture isn't just a little bit off, it's dangerously wrong. Why? Because if you think that's the path to success, you will spend all your energy on the wrong things, you'll be looking in the wrong places, and you're going to completely miss out on the kinds of opportunities that can generate truly life-changing returns.
And that leads us right into the real heart of Fisher's philosophy. It all comes down to a fundamental choice between two totally different ways of thinking: bargain hunting versus investing for growth. Okay, so this is that spreadsheet genius we were just talking about, the statistical bargain hunter. Their whole game is finding a mathematical mistake in the market. They look at a company's books and say, aha, this stock is statistically cheap. The market says it's worth $1, but the numbers say it's worth $1.50. This right here, this slide just lays out the two mindsets perfectly. The bargain hunter, on the left, is looking for a quick flip. They want to find a stock that's maybe 50% undervalued and cash out. The growth investor, on the right, is looking for a long-term partner, a business that can grow and grow for years, maybe by hundreds of percent. And the risks are totally different. The bargain hunter might discover that the stock is cheap for a very good reason, like the business is secretly falling apart. The growth investor's risk is that the amazing future they're betting on, well, it just doesn't happen. And Fisher's point here is that even when the bargain hunter is right, even in their best-case scenario, the prize is pretty limited. You might make a nice, solid 50% gain, but that's it. It's a one-and-done deal. But the growth investor, they're playing a completely different sport. It's not even in the same ballpark. They are not interested in a quick 50%. They're looking for those rare companies that can compound their value over and over again, leading to returns that are just mind-boggling, 700% or even more. It's a whole other level of wealth creation. So you might be asking, okay, if the path to these amazing returns isn't buried in spreadsheets, what does a growth investor actually do all day? Well, it's way less about calculation and way more about investigation. It's more dynamic and, frankly, a lot more interesting. This lays out the real process, and it looks a whole lot more like detective work, doesn't it? It's about getting away from the desk, picking up the phone, and actually talking to people. You talk to customers, you talk to suppliers, you might even talk to competitors to build a 360-degree view of a business. This is how you find out the things that will never, ever show up in an annual report. This is how you build trust and ask the right questions to get to the real truth. So, the qualities that make a great investor aren't what most people think. It's not about being an accounting expert. It's about being genuinely curious about how businesses work. It's about having good judgment to figure out what information actually matters. And it's about being able to connect with people. It really is about being a detective, not an accountant.
Now, hearing all this, you're probably thinking, wow, that sounds like a full-time job. And you know what? You're not wrong. Which leads every single one of us to a huge decision. Are you going to be the detective yourself, or are you going to hire one to do it for you?
Fisher has this just brilliant way of putting it all into perspective. He asked a really powerful question. We all know we shouldn't try to be our own doctor or lawyer, right? So why on earth do so many of us think we can be our own expert investment manager? I mean, his argument here is pretty hard to ignore. Unless you have the time, the specific skills, and a real genuine passion for doing this kind of deep investigative work, you are probably better off finding a professional. And that's not admitting defeat. It's just being smart and recognizing the value of real expertise.
But, and this is a big but, if you do decide to hire someone, you have to be incredibly careful. Fisher gives us a great, simple checklist here. First, demand to see their track record, not just their best picks, but a real cross-section of results over at least 5 years. Second, their honesty has to be beyond question. And third, and this is so important, their core philosophy has to match yours. You don't want a bargain hunter managing your growth portfolio. That's a recipe for disaster.
Okay, so let's say you're on board with this whole growth idea. Whether you're doing it yourself or you've hired a pro, you need to understand that the term growth stock isn't just one thing. These companies exist all along a spectrum, from pretty conservative to extremely high risk. Fisher really breaks them down into two main types. On one side, you've got the big, established growth companies. Think of the giants of their industry. They're financially strong, they offer steady, reliable growth, and the risk is relatively low. On the other side, you've got the young, high-potential upstarts. The potential gain here could be absolutely life-changing, but the risk is also off the charts. You could easily lose every penny. So for most people, Fisher says the bulk of your portfolio, the real core, should be in those established, steady growers.
And this next point, man, Fisher is practically screaming this from the rooftops, especially for the average investor. You should only be investing in individual stocks with money that is truly surplus. What does that mean? It means this is money left over after you've built up a solid emergency fund and after you've saved for the big stuff like a house or college. The stock market is not the place for money you might need anytime soon.
All right, let's bring this all home and look at the long-term payoff, because this is where the magic really happens. It's not just about the stock price going up and up. There's this other, often overlooked benefit that is just as powerful over time.
Okay, check this out. This is such a great example of what I'm talking about. The power of dividend growth. A lot of people avoid growth stocks because the starting dividend yield is really low. But look at what happened with Dow Chemical. Back in 1946, it paid a pretty modest 2.5% dividend. But the company grew, and as it grew, it raised its dividend payment again and again. By 1956, just 10 years later, an investor was getting an 8.5% return in cash every single year on their original investment. That's an incredible income stream.
And this isn't just one lucky example. Fisher makes it clear that decades of data back this up. Over the long run, the best growth stocks don't just give you better capital gains. That's the stock price going up. They eventually end up giving you a better income stream too. For the patient investor, it is the ultimate win-win.
So really, it all boils down to one fundamental question you have to ask yourself. Are you investing your money for a little bit of extra income today, or are you trying to build significant, life-changing wealth for tomorrow? Fisher's wisdom makes a pretty powerful case that focusing on tomorrow is by far the most rewarding journey you can take.
All right, let's talk about one of the biggest questions in investing, one that I know I've wrestled with for years. You do all the work, you find a truly great company, but then what? When is the right time to actually pull the trigger and buy? Get this part right, and it's the difference between a nice profit and a return that can genuinely change your life.
So here's how we're going to break it all down. First, we'll lay out the core problem, what I'm calling the investor's dilemma. Then we're going to debunk a huge myth about forecasting. After that, we get to the good stuff, the right time to buy with some real-world stories to back it up. From there, we'll build a practical strategy you can actually use. And we'll wrap up by talking about what's knowable versus what's, well, just unknowable.
Okay, so let's jump right into the big question. You've put in the hours, you've found a fantastic company, a real gem with a bright future. So, does it really matter when you buy it? I mean, shouldn't a great company be a great investment no matter what? It sounds right, but as we're about to see, the timing of your purchase can be everything.
To really drive this home, let's do a little thought experiment. Imagine you had a crystal ball. You knew who the big winners of the 20th century were going to be, but your timing was just awful. You bought them all in the summer of 1929, right before the Great Crash. Sure, you'd probably have made money eventually, but man, it would have taken decades just to get back to even. Your returns would have been a shadow of what they could have been.
And that's the whole point, right? Timing isn't just a small detail, it's a massive lever. Yes, a great company will probably make you money over the long haul, but that extra bit of effort, that focus on when to buy, that's what turns a good investment into a spectacular one. So if it's that important, how do people usually try to do it? Well, that leads us to a pretty big and common mistake.
So, when you hear market timing, what's the first thing that pops into your head? For most people, it's trying to predict the economy. Is a recession coming? Is the market going to boom? They try to read the tea leaves and make their moves based on that.
The legendary investor Philip Fisher had just the perfect way to describe this. He said that trying to forecast the economy is like practicing alchemy in the Middle Ages. It's this messy, mysterious blend of hope and nonsense, but it sure isn't a science, and it's definitely not something you want to bet your retirement on. And he was spot on. Just pick up any financial newspaper from a year ago or 10 years ago, you'll see tons of experts, all completely certain, and all completely disagreeing with each other. Some are screaming that the sky is falling, others are saying it's blue skies ahead. It's a massive waste of brainpower trying to do something that, frankly, can't be done reliably.
Okay, so if we're not supposed to be playing the guessing game with the economy, what should we be doing? Well, the answer is actually found by looking at the companies themselves. See, the path for even the best, most innovative companies is never just a smooth ride up. There are always bumps in the road. And this cycle right here, this is the key. Let's walk through it. It starts with tons of hype, right? A company announces some amazing new product and the stock shoots up. But then reality sets in. The new factory has problems. It's costing more than they thought. There are delays. It happens all the time. Suddenly earnings dip. The headlines turn sour. Management screwed up. The same people who bought on the hype, they get scared and they sell, pushing the stock price way down. And right there, at that exact moment when everyone is panicking, that's your sweet spot. That's the sensational buying point, because you know it's just a temporary problem for a great long-term company.
Now, I know that sounds good in theory, but let's look at how this plays out in the real world. Because these stories, they really bring the whole idea to life. They show you what it looks like to buy when everyone else is running for the exits.
Take American Cyanamid back in the 50s. The feeling on Wall Street was pretty negative. People thought it was just a hodgepodge of old, inefficient businesses. And to make matters worse, their brand new, massive 40A plant was having all sorts of expensive problems. It was the absolute peak of pessimism. But for the investors who dug in and saw that these are just startup issues, not a fundamental flaw, well, they bought in and were rewarded with absolutely massive gains as the company worked through the kinks and started to fly.
And here's the part of the story I really love. It's the honesty. The author admits that, yeah, they sold and made a fantastic profit. But looking back, it was probably a mistake. The company just kept getting better and better, and holding on would have made them even more money. It's such a great reminder that with these truly wonderful companies, sometimes the hardest part is just staying put.
Let's look at another one, food machinery and chemical in 1957. The market had a pretty clear story here. It was a great machinery business that was being dragged down by this terrible low-margin chemical division. The focus was entirely on the negative and nobody wanted to touch it.
But here's what was happening that nobody was paying attention to. A new management team was hard at work pouring money into modernizing those old plants and beefing up their research. All that spending hit the earnings in the short term, so on the surface it looked bad. But under the hood, they were building an incredible business for the long haul. So what happened if you bought in during that period of negativity? You would have seen a gain of 102% in just about 2 years. The market finally caught on to what was really happening, and the stock price exploded. The opportunity wasn't when the good news was out, it was when the perception was terrible. So what's the thread that ties these stories together? It's this simple, beautiful idea. The best time to buy is when you can see a major improvement coming down the pike for a great company. But, and this is the important part, the market hasn't noticed yet. The stock price is still asleep at the wheel. You're buying the good news before it becomes news.
All right, so we get the principle now. We're looking for temporary trouble. But how do you actually put this into practice? How should you build your own buying strategy? Well, it kind of depends on where you are in your own investing journey.
And I think this is some of the most practical advice in the whole book. If you're a seasoned investor, you've got a portfolio, you've got some gains built up, you can afford to be decisive. When you spot one of these opportunities, you can pounce. But if you're new to the game, the smart move is to take it slow. Stagger your buys over a few years. It protects you from the awful luck of going all in right at a market peak. And just as importantly, it lets you test your own process to prove to yourself that you know how to pick them before you're fully invested.
Okay, let's zoom out one last time and put a final frame on all of this. Because what this all boils down to is a choice about where you're going to focus your precious time and energy. It's about shifting from guessing to actually analyzing.
You have to remember, that business cycle that all the forecasters are obsessed with, that's just one piece of a giant, complicated puzzle. You've also got interest rates, government policies, inflation, wild new technologies, all these huge forces, and they're almost never all moving in the same direction. Trying to predict how they'll all interact is, well, it's pretty much impossible.
And this brings us to the core lesson, the big paradox of smart investing. The thing that feels risky, ignoring all the scary headlines and the noise about the economy, is actually the safest thing you can do. It is so much safer to act on what you can know about one specific company than it is to act on what you can only guess about the entire global economy. So I'll just leave you with this question to think about. When it comes to your own investing, where are you spending your energy? Are you caught up in the modern-day alchemy, trying to guess the unknowable, or are you doing the real work, the hard but rewarding work of understanding a business and waiting for your moment? Your answer to that question really will make all the difference.
Anyone can click buy on a stock. That's the easy part. But knowing when to sell, that is the real test, isn't it? It's one of the hardest, most gut-wrenching decisions we have to make as investors. It's just loaded with fear, with greed, with doubt. And honestly, it's where most people get it completely wrong.
I mean, this is the question that probably keeps you up at night, right? You've got a stock that's doubled, maybe tripled, and you're thinking, should I just lock in these gains, take the money and run? Or on the flip side, the market starts to tank and that little panic button in your brain starts flashing, get out now. It's a constant source of anxiety.
But what if there was a better way to think about all this? What if you could cut through all that noise and emotion? Well, that's exactly what we're going to do today. We are going to dive into a super simple but incredibly powerful framework from one of the all-time greats, Philip Fisher. The goal here is to give you a tool to answer that one crucial question, when to sell, with real clarity and confidence.
Okay, so before we get to the right reasons to sell, we've got to talk about the wrong ones. Because according to Fisher, most of the time when people sell, it's for reasons that are, well, they're just huge mistakes. They're driven by gut feelings and fear, not by sound logic. And these are the very traps that can literally cost you a fortune down the road. So let's break them down.
All right, trap number 1. This is the big one, the classic, trying to time the market. You know how it goes. You turn on the news, you hear whispers about a recession, the market takes a little dip, and your gut just screams at you to sell everything and run for the hills. It feels like you're being smart, right? Like you're protecting your capital?
But let's look at the real cost here, because this is where it gets brutal. That feeling of fear makes you sell what might be an absolutely outstanding company. Then, boom, you get hit with a capital gains tax bill. And now you've got an even bigger problem. When the heck do you get back in? Fisher pointed out that for every 10 people who sell to dodge a crash, maybe, one gets back in before the stock blows past where they sold it. You end up missing the inevitable rebound in the next new peak. It's a loser's game.
Okay, on to trap number 2. And this one is sneaky because it sounds so smart and logical. You look at a stock's price-to-earnings ratio, you see it's gotten a little high compared to its history, and you think, aha, this thing is overpriced. Time to be the smart one in the room and lock in my gains.
But here's the thing Fisher really hammered home. Trying to decide if a truly great growth company is overpriced it's an exercise in false precision. You're trying to be too cute. The market is almost always behind in understanding the full potential of these businesses. So ask yourself, is it really worth it to sell, pay a big tax bill, and give up your seat on a rocket ship that might quadruple over the next decade, all because you think it's maybe 20 or 30% overvalued today? The cost of being wrong here is astronomical.
And that brings us to trap number 3. This is the one that Philip Fisher himself called, and I'm quoting here, the most ridiculous of all. It's the simple but totally flawed idea that just because a stock has already gone up a ton, its run must be over. So what do people do? They sell their best performing stock, their winner, to go buy some loser that hasn't had its run yet. It's madness.
So, okay, if all of those are terrible reasons to sell, what are the right ones? Now that we've cleared away all that emotional clutter, we can get down to a truly disciplined way of thinking. According to Fisher, if you've done your homework right and you've bought a really great company, there are only, and I mean only, 3 valid reasons to ever hit that sell button.
And here they are. That's it, just 3. This is the whole framework. Notice it has nothing to do with predicting the economy or freaking out about PE ratios. It is all about the business itself. Let's dig into each one.
All right, reason number 1. It's the simplest on paper, but maybe the hardest one to actually do. You admit you made a mistake. You realize that your original thesis for buying the stock was just wrong. Maybe you find out the management team isn't as brilliant as you thought, or that their moat isn't as wide and deep as you believed. The key is to have the humility to admit it, take the loss, and move on quickly.
And this is where your EO becomes your worst enemy. Fisher was so clear on this point. He said that the single-minded desire to just get back to even on a bad investment has probably destroyed more wealth than anything else. It's your ego battling your bank account. But look, selling a mistake isn't just about stopping the losses. It's about freeing up that cash to go find a real winner.
Reason number 2 to sell is when the facts change. The company you own today is simply no longer the great company you originally bought. It happens. Even the best companies can stumble. Maybe the management team gets lazy and complacent. They lose that fire. Or maybe the company has just gotten so big that it's run out of room to grow. It's saturated its market. This is why you can't just buy and forget. You have to be a vigilant owner, constantly asking yourself,
Does this company still pass the test?
And Fisher actually gave us a fantastic, really practical test for this. Just ask yourself this one simple question. Looking ahead to the peak of the next business cycle, do I honestly believe this company can grow its earnings by as much as it did during the last cycle? If the answer is a clear no, then its best growth days are likely behind it, and it might be time to move on.
Now for the third and final reason, and listen, this one should be rare. This is when you find a clearly superior opportunity. And the bar for this is incredibly high. We are not talking about selling a great company to buy a slightly more great company. No, we're talking about a situation where you find something so unbelievably compelling. Let's say you think it can grow at 20% a year while your current holding can only do 12, that the difference is so massive it's worth paying the taxes and making the switch.
So, there you have it, the 3 reasons. But they all point to one single, powerful master principle. And to really drive this home, Fisher used this amazing analogy that I promise you will completely change how you think about selling your best stocks.
I want you to imagine something. Picture yourself on your graduation day. You're looking around at all your classmates, and someone comes up to you with a once-in-a-lifetime offer. You get to invest, but not in stocks. You get to invest in people. Here's the deal they offer. You can pay 10 times their first-year salary to get 25% of their earnings for the rest of their life. But you can only pick 3 people. So what would you do? You'd immediately start sizing everyone up, right? You wouldn't pick the nicest person. You'd pick the ones with the most drive, the most talent, the most ambition to become a massive success. You'd be hunting for your 3 future superstars.
Okay, now let's fast forward a decade. 2 of the people you picked are doing okay, good jobs. But the third one? Oh, she's become a superstar executive at a huge company. Her earnings are just going through the roof. Then someone comes along and offers you a 600% profit right now to sell your contract on that superstar. So what do? Would you seriously sell your stake in this future CEO just to buy more of a stake in the classmate whose career is totally stalled out? Would you justify it by saying the superstar has already had a big advance? Of course not. That sounds completely insane, right? And yet, that is exactly what investors do every single day when they sell their winners to average down on their losers.
And that brings us right to Fisher's grand conclusion, his master principle. It's this. If you have done the job correctly when you buy a stock, if you've truly found an outstanding business with a great management team and a long road of growth ahead of it, then the right time to sell it is almost never. Look, the big money, the real wealth in investing, it isn't made from clever trading. It's made by patiently holding on and letting the magic of compounding work for decades. When you sell a true winner too early because you got scared or you thought it was overpriced, you're not just leaving a little bit of profit on the table. You are potentially forfeiting the kind of life-changing wealth that builds legacies.
So I'll leave you with one final question to really think about. This is the absolute core of Philip Fisher's entire philosophy. When you look at your portfolio, what do you really see? Do you see a bunch of ticker symbols that you're supposed to trade, or do you see what they actually are? Ownership stakes in real, living, breathing businesses that you want to be a partner in for the long haul. Because really, your answer to that one question, it will determine everything.
When it comes to stocks, there are all sorts of weird ideas floating around. But honestly, nothing seems to create more of a tangled mess in people's minds than dividends. It's a topic where half-truths get passed around like gospel. So today, we're going to cut right through all that noise. And that's exactly where we're going to start, this monumental confusion. Our goal here is to completely dismantle the myths, and by the end of this, give you a clear, powerful way to think about what dividends really mean for you and your money. So, here's how we're going to break it all down. First, we'll talk about why dividends are so tempting in the first place. Then, we'll look at how reinvesting that money can sometimes go badly wrong and the tough spot that growth stocks can find themselves in. After that, we'll dive into the massive advantage of reinvestment, why consistency is the real key, and we'll wrap it all up with a paradox that might just flip how you think about returns on its head. All right, let's dive right in with the big one, the idea that pretty much everyone just accepts as fact, that a company paying out more cash to its shareholders as dividends is always, without question, a good thing. Even the way we talk about it in finance just feeds this bias. You hear it all the time when a company bumps up its payout. The story is that management is finally rewarding the owners. The implication is what? That by keeping the money to grow the business, they were somehow doing nothing for you? That's just crazy, and frankly, it couldn't be farther from the truth. And this is the box we're all taught to think inside, right? Dividend goes up, good. Dividend gets cut, bad.
It's so simple, so clean. But it's also a dangerously incomplete picture, because it completely ignores the most important question of all. And here it is. What if that cash, instead of being mailed out to you in a small check, could be used by the company to build a brand new factory, or maybe develop a game-changing new product? What if that reinvestment could generate a return that blows the dividend payment out of the water? This question, this is the key that unlocks this entire topic. Now, to be perfectly fair, just because a company keeps the cash doesn't mean good things will happen. Reinvesting earnings is not some magic bullet. Management can absolutely screw it up, and stockholders get nothing out of it. And it usually happens in one of two main ways. The first failure is pretty simple. They just hoard the cash. Some managers get this warm, fuzzy feeling of security from sitting on a giant mountain of money. They're not using it for growth, not for innovation, they're just sitting on it. In that case, they're not creating any value. They're just holding on to wealth that actually belongs to you, the shareholder, and could be put to much better use somewhere else. But this second way, man, this one is so much more destructive. This is when a poorly run company uses its profits not to fix its problems, but to just make its inefficient operation bigger. They're literally throwing good money after bad, creating a larger, less profitable empire, often just to make themselves feel important or justify a bigger paycheck. And the stockholder, they end up holding the bag with nothing to show for it. But here's where it gets even trickier. Because even for the good companies, reinvesting all their earnings might not lead to a higher stock price. It's wild, but sometimes a company has to spend enormous amounts of money just to keep from falling behind. It's like running on a treadmill. There are really two invisible forces working against them here. First, there's just competitive spending. The classic example is a retail store installing air conditioning. Does it bring in a flood of new customers? Probably not. But you can bet your bottom dollar that if they didn't have it, their current customers would be running across the street to the competitor who does. And second, the really big one, inflation. The money a company set aside to replace a 20-year-old machine was based on what it cost back then. Well, that's nowhere near enough to buy a new one today, so a huge chunk of their earnings gets eaten up just maintaining the status quo. Okay, this brings us to the absolute core of this whole discussion. We are now going to completely dismantle the single biggest, most common myth about who dividends are really for. You've probably heard this one a million times. The idea that not paying dividends is just a sneaky trick to help rich people avoid taxes. But that is totally, completely wrong. The reality is nothing to do with how much money you have. It all comes down to whether you are in a phase of your life where you're building wealth. If you're putting any money aside for the future, no matter how small, then having the company reinvest for you is almost always the more powerful choice. And the math on this? Well, the math is simple and it doesn't lie. When a great company keeps $1 of its earnings, that entire dollar, 100 cents, goes right to work growing the business, instantly. But when they send that same dollar to you as a dividend, first, Uncle Sam takes his cut through taxes. Then, when you go to reinvest what's left, your brokerage might take a little commission. That dollar you started with is now maybe 85 cents. It's a leaky bucket. So this creates two huge, powerful advantages. First, pure efficiency. You avoid all that leakage from taxes and fees. 100% of your money stays working for you. And second, expertise. I mean, think about it. You already did the hard work of finding this outstanding company with a great management team, right? You already trust them. So you're letting those same experts make the next investment decision for you, instead of you having to go out and find a whole new investment that's just as good. And that's no easy task. So, if the size of the dividend isn't the most important thing, what is? What should we really be focused on? The answer is simple: the policy. It's all about predictability. It's about trust. There's this fantastic analogy that just nails this point perfectly. Imagine your favorite restaurant. You go there because you know what to expect. But what if one day they served 5-star steak, and the next day it was a cheap hot dog stand? You'd get confused and you'd probably stop going. You can't build a loyal following that way. Well, a company's dividend policy is exactly the same thing. A wise dividend policy follows 4 really simple common-sense steps. 1, it's based on reality. How much cash does the business actually need to grow? 2, they tell you what the plan is, so there are no surprises. 3, they only raise the dividend when they are dead certain they can keep paying it at the new, higher rate. And 4, they avoid all those weird one-shot special dividends that just create confusion. It's all about consistency. Because at the end of the day, that inconsistency just kills investor confidence. A management team that's all over the place with its dividend policy is basically shouting to the world that it doesn't have a solid long-term plan. And that just repels the exact type of loyal, long-term shareholders that every great company wants to attract. And that brings us to our final section, and honestly, the most powerful idea of all. It's a paradox that turns all the conventional wisdom about dividends completely upside down. Let's look at a real-world example, a company called Rohm and Haas. Back when it went public in 1949, it paid a tiny dividend. The yield was super low, so all the conservative income investors took one look and passed. But the company reinvested its earnings brilliantly, and over the next decade, the stock produced a more than tenfold return for its owners, a true 10-bagger. And that right there is the great dividend paradox in a nutshell. It's a funny thing, but it's true. The investors who give the least thought to the immediate dividend payout are often the ones who end up with the absolute best dividend return in the long run. That's because growth, fueled by those wisely reinvested profits, is the true engine that drives future dividends. I mean, a company that's growing its earnings by 15% a year can literally double its dividend every 5 years without even changing its payout ratio. The high-yield stock with no growth just can't compete with that kind of compounding power. So I'll leave you with this final thought. The common question, what's the yield, is the wrong question. It focuses on harvesting the few apples on the tree today instead of planting a bigger orchard for tomorrow. The better question, the far more profitable question, is how good is this management at taking $1 of earnings today and turning it into more than $1 value in the future? That is the question that leads to extraordinary results. You know, when we think about getting ahead in investing, our minds usually race to find that one big winner, right? That one stock that's going to change everything. But what if I told you that real long-term success has just as much to do with the big mistakes you don't make? Well, today we're going to dig into the timeless wisdom of a true investing legend, Philip Fisher, to uncover 5 critical don'ts that can save you from some of the most common and costly traps out there. Let's get into it. So let me just start with a question for you. When you're putting your own money on the line, what do you think is the absolute most dangerous thing you can possibly face? You know, the answer might not be what you think. It's not about the stuff you don't know. The real danger lies in the well-disguised, really seductive traps that you walk right into without even a second thought. These are the mental shortcuts, the common myths that can trip up even the sharpest investors. So let's pull back the curtain on 5 of them. All right, first up is a temptation that gets so many people. It's the lure of the shiny new thing. You hear about some revolutionary new company, maybe it's about to go public, and you get that powerful feeling, that itch to get in on the ground floor. It's exciting. It feels like you found a secret. But Philip Fisher gives us a serious warning here. This is one of the riskiest plays an individual investor can make. This slide really just nails the difference. On the left, you see the promotional company. What are you really investing in? You're investing in a blueprint, a guess. And often, the whole thing is run by just 1 or 2 people. Now look at the right side, the established company. Here, you're buying into actual operating functions, a real observable track record, and a management team that's proven they can work together. It's the difference between a great story and a great business you can actually analyze. And here's where the rubber meets the road. These new ventures, they're almost always unbalanced. You might have a genius inventor who has no clue how to sell anything, or a fantastic salesman who can't manage a budget to save his life. They just don't have a complete team. And here's Fisher's key insight. You, as an individual investor, can't parachute in and fix that. The bottom line, leave these high-wire acts to the specialists who can actually fill those gaps. For the rest of us, the odds of hitting a home run are just way too low. Okay, let's move on to our second don't, and you'll see how these ideas start to connect. This one tackles a really common fear, stocks that aren't traded on the big, famous exchanges like the NYSE. There's this persistent myth that these over-the-counter stocks are shadier, riskier, or just not as good. Fisher says that thinking this way is a huge, huge misunderstanding. So what even is an OTC stock? Well, it's pretty simple, actually. It's just a stock that's bought and sold through a network of dealers instead of at one central place like the New York Stock Exchange. It's not a different kind of company, it's just a different kind of marketplace. This table breaks it down perfectly. Let's start with how it works. An exchange is an auction market. Brokers are just matching buyers and sellers. But the OTC market is a dealer market. Dealers are actually trading from their own inventory. That leads to the next point, pricing. On an exchange, the price you see is the last price someone paid.
In the OTC world, it's all about the bid and ask prices the dealers are quoting. And that brings us to the profit source. Exchange brokers make a commission. OTC dealers, on the other hand, make their money on the spread, that little difference between the bid and ask. This actually incentivizes them to be what you might call stock salesmen, which can sometimes mean more buyers for a stock.
So here it is, the main takeaway. Do not get hung up on where the stock is traded. A phenomenal company is a phenomenal company, whether its shares trade on a big exchange or over the counter. Your job is to analyze the business itself, not the plumbing of the stock market. Passing on a great company just because it's not on the big board is a massive unforced error. Okay, our next two don'ts are all about what's going on between our ears. They're psychological. They're about how we process the stories that companies tell us. And these are really subtle traps because they play on our natural human instincts, which can make them incredibly expensive if we're not paying attention. Man, this is such a brilliant analogy from Fisher. Think about it. You get that annual report in the mail. It's slick, it's got beautiful pictures, charts that only go up and to the right, and a really optimistic letter from the CEO. It makes you feel good, confident. But Fisher's point is that letting that tone sway your decision is exactly like buying a car just because you liked the billboard. An annual report is, first and foremost, a marketing document. You have to look past the fancy wrapping and dig into the cold, hard facts of the business. Now, the second psychological trap here is a little more technical, but oh boy, is it common. It's all about the price-to-earnings ratio, the PE. You find a fantastic company, but its PE ratio is, say, double the market average. And your brain immediately goes, whoa, too expensive, all the good news, all that future growth, it's already priced in. Fisher says this is a deeply flawed way of looking at things. Let's just walk through this flawed line of thinking. 1. You see the high PE. 2. You see the forecast that earnings will double in 5 years. 3. You jump to the conclusion that it's overpriced. But here is the critical missing piece of the puzzle. If this company is genuinely that great, why on earth wouldn't it still command a premium PE ratio 5 years from now? If it does, and its earnings have doubled, well, then its stock price will have doubled too. The market consistently pays up for quality. The mistake is assuming that premium is just going to evaporate. And that brings us to our final don't. And honestly, this one might be the most painful, because on the surface, it seems so smart. It's about being frugal, trying to pinch a few pennies on your purchase price. Fisher tells a true story about this that is just absolutely devastating. So the setup couldn't be simpler. An investor, an experienced one, finds a fantastic company he wants to own. He wants to buy 100 shares. The stock is trading at 35.5. But he thinks to himself, why should I pay that extra $0.50? I'll save a few bucks. And so he puts his buy order in at an even 35. And there it is, the fatal decision. He was stubborn, he refused to budge on his price, and the stock, well, it never came back down to his number. It just took off, and for the next 25 years, it never once traded at 35 again. Let's just be crystal clear about what was at stake here. On his 100 shares, that $0.50 per share meant he was trying to save a grand total of $50. 50. That's it. It sounds like a prudent little move, right? But that decision to save $50 cost him, at a bare minimum, over $46,500 in profits. He missed the entire incredible run of the stock because he was haggling over pennies. The opportunity he lost was just staggering. Fisher does not mince words on this one. He calls it financial lunacy. And the math is just brutal. That investor would have needed to pull off his $50 savings trick successfully 930 separate times, without a single mistake, just to break even on this one blunder. When you find the right company, the goal is to get in. Don't let a few quarters stand in the way of a potential decade of growth. So, after all that, what's the big takeaway? Well, these 5 don'ts aren't just a random list of tips. They're really the foundation of a disciplined investment mindset. It's a mindset that puts careful analysis of a business ahead of emotional reactions and all the noise out there in the market. Here they are, all in one place, your checklist. 1. Don't buy the unproven blueprint. 2. Judge the business, not the stock exchange. 3. Read past the glossy marketing. 4. Understand that real quality always costs a bit more. And 5. When you find what you're looking for, don't miss the whole opportunity by haggling over pocket change. And all of this really leaves us with one final big question for you to think about. Take a hard look at your own process. Are your decisions really based on disciplined, timeless rules like these? Or are they being driven by the fear, the greed, and the momentary impulses that these 5 don'ts are designed to protect you from? Honestly, the answer to that question could be the difference between failure and real long-term success. Thanks for joining me for this explainer.
All right, welcome. Today, we're cracking open a true investing classic, Philip Fisher's Common Stocks and Uncommon Profits. We're jumping straight into Chapter 9 to unpack 5 powerful and honestly pretty counterintuitive pieces of wisdom that fly right in the face of what you usually hear on Wall Street. This is going to be good.
So let's kick things off with a big one. You've heard it a million times, right? Diversify. Don't put all your eggs in one basket. It's drilled into us as the absolute bedrock of safe investing. But what if it's not? What if that whole idea of safety in numbers is actually making your portfolio riskier? That's the kind of thinking we're diving into today.
So here's the game plan. We're going to walk through 5 of Fisher's big don'ts. We'll start with the diversification trap, then talk about why you shouldn't panic sell in a crisis. We'll get into the rearview mirror trap, why time can be more important than price. And finally, we'll cover why following the crowd is usually a path to mediocre returns. Okay, our first don't is a big one. Don't over-diversify. You know, we're also terrified of putting all our eggs in one basket that we often end up spreading our money so thin that we create a whole new kind of risk, one that's a lot harder to see. Look, on one side, you've got the old playbook that says more is better. Own dozens, even hundreds of stocks for safety. But Fisher comes along and says, hold on a second. He argues that this approach just leads to a massive problem. You end up owning a bunch of companies you know absolutely nothing about. For him, real safety doesn't come from numbers. It comes from deep, genuine knowledge. I mean, Fisher just cuts right to the chase here. Being ignorant about what you own is a much bigger risk than being concentrated. Think about it. If you've done the deep dive on 5, maybe 10 truly fantastic companies, you know their business, their moat, their management, you're in a far, far safer position than someone who owns 50 stocks they picked out of a hat. So that leads to the real question. How much is enough? Well, Fisher actually gives us a pretty handy framework. For the big, stable giants, think of the top growth companies of any era. He says a minimum of 5 is probably fine, with no more than 20% in any single one. Then for his Group B, these solid, mid-sized businesses, you probably want at least 10, maybe with 10% in each. And for the really speculative, high-risk, high-reward plays, he says never ever put more than 5% into any one of them. It's a guide for being thoughtfully diversified, not just blindly diversified. All right, let's shift gears to our second don't. Don't be afraid of buying when there's a war scare. This is all about mastering your own psychology when it feels like the world is coming unglued. That gut reaction when war breaks out, to sell everything and hoard cash, Fisher says that is nothing short of financial insanity.
And you know, when you look back at history, the pattern is just crystal clear. World War I starts, the market tanks. But by the end, it's way, way higher. World War II, same story. Korean War, same story again. The market plunges on fear, but it ends the conflict at a much higher level. That initial panic-driven sell-off has almost always been a terrible time to sell and a fantastic time to be a buyer. So why? Why does this happen?
One word: inflation. It's pretty simple, really. Modern wars cost a staggering amount of money, way more than governments can just collect in taxes. So, to pay for it all, they crank up the printing presses, flooding the system with new money. And when you have more dollars chasing the same amount of goods, each one of those dollars becomes worth less. In that world, cash is the riskiest asset you can own. It's guaranteed to lose its buying power. Stocks, on the other hand, represent ownership in real things, and they become a safe haven.
And this is where Fisher just doesn't mince words. He calls it extreme financial lunacy. War is bearish for money itself, not for the businesses that operate in the economy. So the big takeaway here is that you need to flip the script. Widespread fear isn't a sell signal, it's a shopping signal.
All right, let's get to our third big idea. And this is a trap so many of us fall into. Fisher's advice? Don't forget your Gilbert and Sullivan. Now you're probably wondering, what in the world does a 19th century comic opera have to do with my portfolio? Well, it's actually a pretty brilliant way to remember what's important when you're looking at a stock. The analogy goes like this. In the opera, there's a line about the flowers that bloom in the spring having nothing to do with the case. And Fisher argues that a stock's past price, or its past earnings, they have about as much to do with its future value. Staring at a 5-year stock chart is just driving while looking in the rearview mirror. What matters is what's on the road ahead of you.
Let's make this real with an amazing example. Texas Instruments, back in 1956. Now, if you were a rearview mirror investor, you would have seen earnings that were just dead money for years, stuck around 40 or 50 cents a share. You'd see a stock price of 14 bucks and probably think it's way too expensive for that. But what was about to happen had everything to do with the future, the transistor revolution, and nothing to do with that boring past. Look what happened. Earnings just exploded from 70 cents to $3.50 in a few short years.
And the stock? It went absolutely parabolic. It shot up over 1,000% in less than 4 years. The lesson is just so clear. A company's history is mostly noise. Your job as an investor isn't to figure out what the last 5 years of earnings were. It's to figure out what the next 5 years are going to look like.
Okay, this next one is a little more subtle, but man, is it powerful. The fourth don't is, don't just think about price, think about time when you're buying a great growth stock. This is all about playing chess when you see a big, positive change coming down the pike.
So imagine this. You've done your homework, you've found an absolute gem of a company, you're convinced it's going to be worth way more in the future, but today, the stock feels a bit pricey. But you also know something big is coming, a new factory's opening in 6 months that's going to dramatically boost earnings. So what do? Do you sit back and wait for the stock to drop to some arbitrary target price? Or do you think about a target time?
So here's Fisher's brilliant, counterintuitive take. That target price you're waiting for, it may never arrive. If you have real conviction about that future catalyst, your actual goal should be to buy the stock near the lowest price it will ever see from this point forward. And a disciplined way to do that is to pick a date, say a month before that new factory goes live, and just buy then, whatever the price is. You're timing your entry to get in before the good news becomes obvious to everyone.
And that brings us to our last big don't, and it's a huge one. Don't just blindly follow the crowd. You know, the stock market runs on stories, on fads, on emotions, just as much as it runs on balance sheets. And the biggest opportunities, the truly life-changing ones, they show up when the story everyone believes is just plain wrong.
Fisher tells this great story about the machine tool industry. See, before the 1957 recession, this new narrative took over Wall Street. The crowd decided it wasn't a feast or famine cyclical business anymore. No, they said, it's a stable growth industry now. They believed corporate planning had solved the boom and bust cycle. But then, the recession hit, and it turned out the old reality was still very much alive. The popular story was a complete fiction, and the investors who saw through it got a massive opportunity.
And really, that's the whole game, isn't it? As Fisher says, the ability to tune out the noise, to look past the popular narrative and just focus on the facts, that's the skill that leads to the really big returns. It's not easy, believe me. The pull of the crowd is incredibly strong, but that's where the uncommon profits are made.
Okay, so let's pull this all together. Let's reframe these 5 don'ts into 5 powerful truths to live by. Number 1, concentrate your money on the few great businesses you truly understand. 2, see fear and crisis as your invitation to buy. 3, invest in the future, not the past. 4, think strategically about time, not just price, especially when you see a catalyst coming. And number 5, learn to think for yourself and profit from the market's temporary madness. Which leaves us with one final big question for you to think about. Using these principles from Philip Fisher, what story, what popular fad, or what widespread fear in the market today might be completely and utterly wrong? The answer to that question? Well, that could be your next great investment. Thanks for joining us.
All right, welcome to The Explainer. Today we're doing something pretty cool. We're going to crack open the playbook of a true investing legend, Philip Fisher. We're going to get into his almost detective-like process for sniffing out those really rare, life-changing investments. So if you're looking for quick tips, this isn't it. This is more like a masterclass in how to find real growth stocks.
So this is the big one, right? The multi-million-dollar question. How on earth do you find an investment that could go up 10 times in 10 years? You know, Philip Fisher, he wasn't interested in just beating the market by a little bit. No, he was hunting for what he called a bonanza. We're talking about the kind of company that literally builds fortunes over a decade. And for him, finding one wasn't about luck. Not at all. It was all about having a very specific, very deliberate method.
Okay, so here's the game plan for how we're going to break all this down. First up, we'll tackle the bonanza stock problem itself. Then, we'll get into finding the right leads. After that, the really fun part, the Scuttlebutt investigation. Then, we'll see how he met with management. And finally, we'll talk about the real price of these kinds of uncommon profits.
All right, first section, the bonanza stock problem. To really get what Fisher was doing, you first have to appreciate the sheer scale of the problem he was trying to solve.
I mean, just think about it for a second. There are literally thousands of companies out there. You, me, even the most dedicated professional. There's just no way to investigate more than a tiny, tiny fraction of them. And what that means is that your very first choice, just deciding where to even begin looking, is maybe the most critical decision you'll ever make as an investor. It really is. And this was Fisher's big aha moment. He realized that if you don't have a system, a filter, you're just going to waste all your time and energy on what he called run-of-the-mill companies. It's like you're prospecting for gold, but you've picked a spot with absolutely nothing in the ground. You're just digging in barren soil, and you're going to completely miss the mother lode. You could easily just toss aside a future 10-bagger without even realizing what you had.
Okay, section 2, finding the right leads. So if that first step is so absolutely critical, how do you actually do it? How do you go from thousands of stocks down to just a handful of really promising ones? Well, Fisher's answer here might actually surprise you.
At first, Fisher thought he had it all figured out. He assumed his network of execs and scientists, the people right there on the front lines of whatever industry, would be his gold mine for ideas. I mean, it makes total sense, doesn't it? But then he did something crucial. He actually looked at the data, at his own track record. And what he found, well, it told a completely different story.
And yeah, look at this breakdown. It is absolutely staggering. I mean, it wasn't even a contest. A full 80% of his best leads, the ideas that actually turned into investments, came from a small, trusted group of other skilled investment professionals. And what about those industry experts? They were only about 20% of his leads and an even smaller piece of his actual winning stocks. Wild, right?
So what gives? Why was that? Well, Fisher figured out that other great investors they speak the same language. They're already trained to think about the stuff that really matters. Sales growth, what the competition looks like, profit margins. They could give him this perfect, concise summary that let him decide, okay, is this company even worth my time? It's like their minds were already tuned to the exact same radio frequency he was listening to.
Okay, now we're getting to the good stuff. The real heart of Fisher's entire process, the thing he's most famous for, the Scuttlebutt investigation. Once he had a good lead, this is where the real work, the real detective stuff began.
Way before he would even think about calling the CEO, Fisher would kick off this huge intelligence gathering mission, and the whole point was to build a complete 360-degree view of the company. And the key word here is unbiased. He got that by talking to literally everyone except the people inside the company.
And his list of sources was pretty incredible. He'd methodically go out and talk to the big customers. Do they really love the product? Then he talked to the competition. What are their real strengths and weaknesses? What's the view from the other side of the fence? He'd talk to suppliers, he'd find ex-employees to get that juicy, unfiltered inside story, and he'd even talk to scientists in the field. This right here is the real grunt work, the shoe leather reporting that turns a hunch into a deeply held conviction.
And this is where his discipline was just off the charts. Fisher was adamant about this. If you can't get enough information, if you're hitting dead ends, people aren't talking, you don't try to force it. You just drop it, move on. And his reasoning was so simple but so powerful. You don't have to have an opinion on every single company out there. You just need to be rock solid, incredibly certain about the handful you do decide to buy. All right, next up, meeting the management team. So only after all that scuttlebutt work was done, we're talking weeks, maybe even months of building this incredibly detailed picture from the outside. Only then was it finally time to actually talk to the people running the show.
And when it came to this, Fisher had one golden, ironclad rule. He believed that walking into a meeting with management unprepared isn't just a waste of time, it's actually dangerous. Why? Because you won't know the right questions to ask, the tough questions. You won't be able to tell if they're dodging something. You're basically just a tourist getting the slick corporate presentation, and you're almost guaranteed to walk away with the wrong impression.
But when you're prepared, oh man, that changes the entire game. The whole dynamic of the meeting shifts. Now you can sit down and say, look, I've talked to 3 of your biggest customers, and they've all mentioned a concern about X. What's going on there? Suddenly you can actually judge how honest and direct their answer is. The management team sees you've done the work, they take you seriously, and boom, you're talking to the CEO, not just someone from the PR department. And this number right here just shows you how powerful that preparation was. Think about this. For every 2.5 companies he actually went to visit, he bought 1. That is an insane conversion rate. It just proves that by the time he walked into their office, the meeting wasn't about discovery, it was about final verification. But this next number, This one puts the whole thing into perspective. There's this story where another investor guessed that Fisher bought 1 out of every 250 companies he visited. And Fisher corrected him. He said, no, that number, 1 in 250, that was the ratio of companies he even considered at the very start of the process to the ones he actually bought. Just think about that. The vast, vast majority of ideas were weeded out by his system long, long before he even thought about a meeting.
Which brings us to our last section, the price of uncommon profits. Because let's be honest, all of this leads to a pretty sobering conclusion. The amount of work we're talking about is just immense, and Fisher knew it. He was under no illusions that most people would look at this and just say, no way, that's too much.
I mean, this is the obvious question, right? How can anyone possibly be expected to spend all this time just to find one single investment? It seems crazy. But Fisher's response was brilliant. He just reframed the entire question. He said, don't focus on the amount of work, focus on the size of the prize.
In what other line of activity could you put $10,000 in 1 year and 10 years later have an asset worth from $40,000 to $150,000? I mean, that quote just cuts right to the core of his whole philosophy. His point was, look, the stock market gives you this incredible, almost unique opportunity to create wealth. But it's just nuts to think you can get those kinds of massive rewards with minimal effort. It doesn't work that way. You're not going to 10x your money by reading a few reports while sitting on your couch.
So here's the bottom line. Getting extraordinary results in investing, well, it takes the same stuff it takes to be successful in any other really demanding field. It takes a ton of effort, real ability, good judgment that you can only get from experience, and, the vision to see what a company could become long before anybody else does.
And that really leaves us with this one final powerful question. Is the hardest part finding the right company? Or is the real challenge becoming the right kind of investigator? You see, finding a great company is obviously hard. But maybe, just maybe, the real work is in developing the discipline, the process, the entire mindset to be the kind of person who can actually find one. The focus shifts, doesn't it? It's not about finding the stock anymore. It's about becoming the right kind of investor. And that lesson, well, that's just as true and as powerful today as it was back when Fisher first wrote it.
When the markets are going absolutely haywire, it's pretty easy to feel like you're lost at sea. But what if the real secret to getting through the storm isn't some new fancy trading algorithm, but just timeless wisdom? Well, that's what we're going to dig into today. We're looking at Philip Fisher's classic, Conservative Investors Sleep Well, to really understand how to build an investing mindset that lets you, well, sleep well, no matter what the market is doing.
So let's just start with a number. 70%. Just let that sink in for a minute. Back in mid-1974, when Fisher was writing this, that's how far the average stock had fallen from its peak. I mean, we're not talking about a minor dip or a little correction. This was a catastrophic, generation-defining wipeout of wealth.
And Fisher, he didn't pull any punches with his language. He flat out called it a bloodbath. He said the only thing he'd ever seen like it in the 20th century was the Great Depression. Now, that context is absolutely crucial because it tells us we're not just talking about numbers on a screen here. We are talking about a deep psychological crisis.
And that really gets us to the heart of it, doesn't it? A complete and utter collapse of confidence. It's in this environment of just raw fear and despair that Fisher's most powerful ideas really take root.
I mean, seriously, pause and think about that comparison for a second. The mood in the financial world in '74 was being compared to the absolute darkest days of the economy. People weren't just second-guessing a few stock picks, they were questioning the entire idea of putting their money in the stock market at all. And you have to understand that deep, primal terror to get what happened next.
So, what's the natural human reaction when you're terrified of losing everything? Well, you promise yourself you're going to get conservative. But here's the twist. As Fisher so brilliantly points out, that's the exact moment most investors walk straight into a trap.
Of course, it's the most predictable thing in the world. You've just taken a massive hit and you say to yourself, that's it, never again. From now on, it's only safe, conservative plays for me. But Fisher comes along and asks the one question that changes everything. What does that word conservative actually mean?
And this is where the genius of his thinking really shines. See, Fisher realized that most of us mix up being conservative with just being conventional. Conventional thinking, that's just doing what everyone else is doing. You buy the huge, famous companies because, hey, there's safety in numbers, right?
But true conservative investing, that's got nothing to do with popularity. It has a crystal clear mission. Protect the real value, the purchasing power of your money with the least amount of risk possible. And as Fisher showed, those two things are often polar opposites.
And if you want proof, look no further. Back in the day, Penn Central and Consolidated Edison were absolute titans. These were the can't-miss blue-chip stocks that your grandfather would have told you to buy. They were the very definition of safe. And yet, the conservative investors who piled in, they got absolutely annihilated. It's Fisher's Exhibit A for why following the crowd can be one of the most dangerous things you can do.
Okay, so if conventional wisdom is a trap, what's the way out? Well, Fisher says we have to stop using vague words and start being precise. He lays out two incredibly clear definitions that become the bedrock of his whole philosophy.
First, he defines the thing itself. What is a conservative investment? It's not about the famous name or how big the dividend is. It is simply an asset that has the highest probability of maintaining your purchasing power with the lowest possible risk. See the difference? The focus is entirely on the outcome, not the reputation.
And second, just as important, he defines the action. Being a conservative investor isn't a badge you wear. It's not a type of person you are. It is a process. It's the homework, the digging, the actual course of action you have to take to figure out if an investment meets that first definition. It's not about what you buy, it's about the work you do before you buy it.
So it all boils down to this: two simple, non-negotiable requirements. Number one, you have to understand what you're even looking for, that ability to maintain purchasing power. And number two, you have to actually investigate and do the work to see if a company checks that box. If you skip either one of those steps, you're not being conservative, you're just being conventional, crossing your fingers and hoping for the best.
Okay, so we've got the definitions, we've got the two-step framework, we know what we're supposed to do. But Fisher would say, hold on, we're not done yet. Because all the financial smarts in the world are totally useless without the last and maybe most important piece of the puzzle, your own psychology.
So let's just ask it point blank. Is having the rulebook enough to win the game? Can you just follow these steps like a recipe and guarantee your success? Fisher's answer is a clear, loud nope. And that leads to one of the greatest investment quotes of all time, something he said was passed down to him. In the stock market, a good nervous system is even more important than a good head. Think about that. Your brain, your good head, gets you to the starting line, but it's your emotional control, your discipline, your nervous system that actually gets you over the finish line, especially when things get ugly.
So what does a good nervous system actually look like? Well, it's these traits. It's the patience to wait for the right opportunity instead of chasing everything. It's the self-discipline to stick to your process, even when it's boring. And maybe the biggest one of all, it's having the sheer strength of character to think for yourself and go against the herd, whether that herd is in a state of panic or irrational euphoria.
And all of this leads us to Fisher's really powerful conclusion. How should a true investor, a conservative investor, look at one of those terrifying market meltdowns? Is it a signal to run and hide, or is it something else entirely?
What Fisher believed is that these moments of extreme fear and pessimism aren't just things that happen to us, they are tests. They present every single one of us with a fundamental choice. The market itself doesn't have an opinion. The only thing that matters is the perspective and the preparation that you bring to it.
And so, this is the final question he leaves us with, the one you have to answer for yourself. Is a brutal bear market a trap set to catch the emotional, the conventional, the unprepared investor? Or is it what it has always been time and time again, a magnificent opportunity for the few who have done the work, who have the discipline, and who have the courage to think for themselves? The answer, as Fisher would tell you, is entirely up to you.
Have you ever looked at a company and just wondered what separates the ones that are a flash in the pan from the ones that seem to last forever? Well, today we're going to dive into the mind of a true investing legend, Philip Fisher, to figure that out. We're going to explore his principles for finding what he called bulletproof companies, businesses that are really built to dominate for the long haul. You know, that's the big question, right? It's what every single long-term investor is trying to figure out. How do you spot a business that can handle anything? Economic storms, crazy new technology, you name it. It's not about what's hot right now, it's about finding that deep, unshakable strength that's going to be there decades from now. So Fisher had this amazing way of looking at it. He pictured a truly great company as a kind of fortress.
A structure with these super deep foundations, thick walls, and the power to not just defend itself, but to go out and expand its territory. And today, we're going to look at his original blueprints for how to build one. So here's our game plan. We'll start with Fisher's big picture idea, something he called the first dimension. Then we're going to build our fortress, pillar by pillar, looking at 4 key parts: production, marketing, research, and financial skill. And then at the end, we'll step back and see how it all comes together to create a company that's pretty much unstoppable. Okay, so let's start with that big idea. Before you even think about looking at one piece of a company, Fisher said you have to look at its overall health. He called this the first dimension. It's this holistic view. You're not just looking at one number, but at the combined strength of the whole operation. And here's the key takeaway. You can't have a weak link. A company might be an absolute genius at inventing new stuff, but if it can't make that stuff efficiently, or if it doesn't know how to sell it, well, then the fortress has a giant hole in the wall. Real, lasting strength only comes when you have all 4 of these pillars locked in tight. All right, let's lay the first stone. We're starting with the bedrock, the absolute foundation of our fortress, being the lowest cost producer. And this isn't just about being cheap. As you're about to see, this is a massive strategic weapon over the long run. This kicks off this incredible upward spiral. A fat profit margin is like a huge cushion. So when things get tough, you're fine. But your weaker competitors, they start to fail. And guess what? You can scoop up their customers, get even stronger, and you can pay for all that growth with your own cash instead of going into debt. It's a recipe for total dominance. To really see what this looks like, Fisher gives us this simple but just brilliant example. Let's imagine 2 widget companies. They're the same size. Company A, that's our fortress, a low-cost producer. And Company B is a high-cost kind of marginal player. So in normal times, they're both selling widgets for 10 cents. But just look at the difference. Company A, our fortress, is making a really healthy 4-cent profit on every single widget. Company B, they're barely making a penny. They are vulnerable.
But then, a boom hits. The price for widgets jumps up to 12 cents. Now, Company A's profit goes up by a very respectable 50%, but look at Company B. Their profit explodes by 300%. And this, right here, is the trap. In a bull market, these riskier companies can look so tempting because their percentage gains are just off the charts. It's a siren song for speculators.
But you know how it goes. Booms don't last forever. The downturn eventually comes, and the price of widgets just collapses, down to 8 cents. This is the moment of truth. And here's where it all pays off. Company A, our low-cost producer, is still making a profit. It's less, sure, but it's comfortable. But Company B, they are now losing money on every single widget they sell. So while our fortress just weathers the storm, the other guy is facing total ruin. That foundation of low-cost production, it's everything. All right, so we've got our foundation poured, but a fortress, well, it can't be an island, right? It needs gates so business can come in and out, and it needs watchtowers to see what's on the horizon. And that's exactly the job of a strong marketing organization. For Fisher, this wasn't about flashy Super Bowl ads. Great marketing is about being totally plugged into your customers. It's about sensing a shift in what people want and reacting before anyone else does. Think about the companies that saw the move to subscriptions or to plant-based foods way before it was obvious. That's the watchtower in action. This is one of Fisher's most famous lines, and it's so important. You can be the most efficient company in the world with the best product, but if you can't tell your customers why it's great and tell them in their language, not yours, then it's basically worthless. Fisher had this perfect analogy for this. He said an efficient producer with bad marketing is like a huge, powerful engine just roaring with potential, but it's completely crippled by loose pulley belt. All that incredible horsepower is just going to waste doing a tiny fraction of what it's capable of.
Okay, pillar number 3. A fortress can't just sit there with its current defenses. It needs an armory. It needs an innovation lab to cook up the weapons of tomorrow. And that's the job of outstanding research and development.
And you might be thinking, oh, R&D, that's for, tech companies. But no. Fisher saw R&D as working in 2 ways. First, yeah, it creates new products. But second, and this is just as important, it finds ways to make the company itself better, smarter, faster, cheaper. Think about how a delivery company uses tech to plan better routes. That's R&D.
But here's the thing, and this is absolutely critical. Brilliant research can actually become a huge problem if it's not managed right. For an idea to actually make money, it has to be tied to the other pillars. It has to solve a real problem for a customer, the marketing team has to be able to sell it, and most importantly, the company has to be able to make it at a profit. And that brings us to our fourth and final pillar, the one that ties it all together: financial skill. This is the command center of the fortress. It's the treasury that pays for everything and the strategic brain that's guiding every single move.
Look, top-notch financial skill isn't just about balancing the books. It's about having a massive information advantage. It means you know exactly how much money you're making on every single thing you sell, so you know where to focus. It means you have an early warning system that spots trouble before it becomes a full-blown crisis. It makes sure every single dollar is being put to its absolute best use.
Okay, so there you have it. Our fortress is built. We've got the low-cost foundation, the marketing gates, the R&D armory, and the financial command center. When you get all four of those working together, you have a truly resilient company. But Fisher leaves us with one last really important piece of advice. And this is the real secret sauce to Fisher's whole philosophy. A fortress can't just be a static monument. In a world that's always changing, if you're standing still, you are actually falling behind. A truly bulletproof company has to always be on offense, always growing, always improving, because that's the only real defense there is. So I'll leave you with this thought. As you look at the companies out there, use this framework. Ask yourself, does this company have all four pillars? Is it a low-cost machine with great marketing, great R&D, and sharp financial controls? Is it building a real fortress that's going to last for generations, or is it just a fancy-looking facade that's going to fall down in the first big storm? The answer to that question can make all the difference.
Hey everyone, welcome. You know, we spend a lot of time looking at companies, trying to figure out what makes one a good investment and another, well, not so good. But what really separates a decent company from a truly legendary one? The kind of company that lasts for generations. I'll tell you right now, the answer probably isn't where you're looking. It's not buried in a quarterly report or a balance sheet. No, it's something much deeper, a second dimension that's one of the most powerful and most overlooked predictors of long-term success.
So, think about it for a second. When you're sizing up a company, where do your eyes go first? If you're like most of us, you jump right to the numbers, right? The revenue, the profits, the margins. And look, don't get me wrong, those are absolutely crucial. But here's the catch. Those numbers, they're like a photograph. They tell you exactly where a company is at one specific moment in time. They don't tell you a thing about where it's going.
Okay, so here's our game plan. We're going to really unpack what the legendary investor Philip Fisher called this second dimension. We'll start by going beyond the balance sheet. Then we'll get into something called the leadership paradox and what it really takes to build a team that lasts. After that, we'll hit the 3 essential traits of any winning company, see how their people policies become a secret weapon, and stick around, because at the end, I'll give you a really simple clue you can use to spot all this for yourself.
All right, first up, beyond the balance sheet. This is where we start to peel back the layers, moving our focus from the numbers that everyone obsesses over to the real force that creates those numbers in the first place, and that is the people factor.
I love how this breaks it down. The first dimension, that's the what. It's the stuff you see on paper, production numbers, marketing spend, all the financial controls. It's a snapshot of the business today. It's purely about the results. But the second dimension, that's the who and why. It's the people who actually produce those results. It's the engine that's going to keep producing them year after year. You can think of it like this. One is the fruit, the other is the tree. Smart investors, they don't just look at the fruit, they inspect the tree.
And let's be really clear here. When we talk about the people factor, this isn't some fuzzy, kumbaya, feel-good concept. We're talking about the collective, strategic force of a company's leadership, its teams, and its culture. It's the engine that drives sustainable, long-term success, the kind of success that you just can't see on a financial statement. It is, without a doubt, the difference between a one-hit wonder and a dynasty.
Okay, on to our next section, the leadership paradox. It makes sense that this whole people factor thing starts at the very top, right, with leadership. But this is where things get really interesting, because we run into a fascinating and absolutely critical paradox.
So on one side, you've got what's called the vivid spirit. This is your classic, brilliant, driven, entrepreneurial founder, the person with the big idea and the sheer force of will to make it happen. They are absolute rock stars at getting a company off the ground. But for that company to have a life beyond its startup phase, it needs a different kind of leader. It needs a team builder.
This is someone who knows how to delegate, how to empower their team, and how to build a system that is way bigger than any one person. The hard truth is, the genius who starts the company is very often not the person who can scale it.
This quote just nails it. My friend is one of the most brilliant men I've ever known. He always has to be right. In a small company, this may be fine. But as you grow, your men have to be right sometimes too. I mean, that says it all, doesn't it? A leader who always has to be right, they just become a bottleneck. They suffocate talent. Brilliant people won't stick around, and the entire company's growth gets capped by the brainpower of that one single person.
Which leads us perfectly into our next section, building a lasting team. So if it's not about one genius leader, it has to be about building a deep bench of talent that can carry the company forward. And the key to that? Promoting from within.
So, why is this so important? Why promote from within? Well, think about it. The truly great companies, they have their own unique way of doing things, their own culture, their own secret sauce. When you bring in a senior executive from the outside, it's a huge gamble. You're not just hiring a person, you might be accidentally importing a totally different culture that could dilute the very thing that made you successful. Promoting from within protects that special DNA.
And for us as investors, this is maybe the single biggest warning sign you can find. A large, successful company that has to hire its next CEO from the outside, that is a massive, flashing red flag. What that tells you is that the current management has failed, utterly failed at one of its most critical jobs, succession planning. It points to a deep, fundamental weakness in the entire system.
Now, if you want a masterclass on how to do this right, look at Motorola back in the day. They didn't just cross their fingers and hope for good leaders to magically appear. No, they built a machine to create them. Step 1, they'd identify people with unusual promise. Step 2, they'd pull them out of their day-to-day jobs and send them to a special executive institute to learn the bigger picture. Step 3, they'd assess them to see what they were really capable of. And Step 4, they would actively grow this talent, creating a pipeline of future leaders. It was literally a leadership factory.
All right, Section 4, the 3 essential traits. So we've covered the leaders and the teams, but what about the personality of the company itself? Fisher identified 3 non-negotiable traits that have to be woven into the very fabric of an organization for it to be a truly great long-term investment.
First up, trait number 1, embrace change. Now, this doesn't mean just panicking when something goes wrong. This is about being in a state of constant, proactive evolution. It's the willingness to challenge your own successful methods, to look at what's working and say, how can we do this better? It's about fighting off complacency at all costs, because in business, complacency is death.
And Dow Chemical is a perfect case study here. Way before they were forced to, they broke their management into 5 geographic units just to be more nimble. What happened? It created this internal competition that drove performance through the roof. But here's a really brilliant part. They looked at a huge liability, pollution, and instead of just seeing a cost, they challenged their teams to find ways to convert it into saleable products. The result was incredible. They got praise from environmental groups, and they boosted their bottom line. Now that is embracing change.
Okay, trait number 2, value employees. And look, we're not talking about putting up a poster in the break room that says, our people are our greatest asset. This is about a deep, continuous effort to make people at every single level feel like the company is a great place to work, where they're treated with real dignity and respect. You get that right, and the loyalty and productivity you unlock is just off the charts.
Texas Instruments did something amazing with this. They created this whole program called People Effectiveness. Instead of top-down orders, they empowered teams of workers on the factory floor to set their own goals. And you know what happened? The teams almost always set higher goals than management ever would have dared to. And then they do incredible things to meet them, like voluntarily cutting their own breaks. It turned out that peer groups were way more effective than any top-down discipline. And this worked everywhere, from the US to Singapore.
And the third and final trait is what we can call discipline for growth. This is really about having the guts to play the long game. It's the willingness to say no to maximum profits right now in order to spend money on things that will build much, much bigger profits down the road. We're talking about things like R&D, employee training, really deep customer relationships. They aren't just managing for the next earnings call, they're building for the next decade.
Moving on to Section 5, proprietary people policies. So think about it. You've got great leadership, a deep bench of talent, and these 3 essential traits baked into the culture. When you put all that together, you get something really special. You get a competitive advantage that is, for all intents and purposes, proprietary.
And you can actually see the financial payoff. Check this out. Texas Instruments measured this with an index they called People Effectiveness. It was simple: net sales divided by total payroll. Now put yourself in their shoes. Every year their wages are going up, and every year the price of what they sell, semiconductors, is going down. Basic math says that index should be tanking, right? But it wasn't. Because of their culture, it actually went up. Their people were becoming so much more productive that it overcame both rising wages and falling prices. That's just incredible.
And this, right here, is the whole ball game for an investor. Because a competitor can go out and buy the exact same manufacturing equipment, they can try to reverse engineer your product, but what they cannot do is copy a culture of trust and empowerment that's been built over a decade or more. These ways of working with people, they become, in a very real sense, proprietary. They are the ultimate competitive moat, and the best part is you won't find it listed anywhere on the balance sheet.
All right, our final section, the investor's final clue. So this is all well and good, but you're probably thinking, how on earth can I, as an outsider, figure any of this out? Well, Fisher gives us one brilliant, surprisingly simple clue, and it's hiding in plain sight for anyone to see.
All you need to do is look at the company's annual proxy statement. It's a public document. In that statement, you'll find the compensation for the top executives. Now, you're not looking at the total dollar amount. Who cares? What you're looking for is the gap between what the number one executive makes and what the next 2 or 3 make.
And here's the decoder ring. If you see a one-man show situation where the CEO's salary is way, way higher than everyone else's, that's a huge warning flag. It points that centralized, I always have to be right kind of culture. But if you see more of a team approach where the CEO's pay is high, sure, but it's followed by a gradual, reasonable decline for the other execs, that is a very good sign. It suggests power is shared, that it's a genuine team running the show.
So I'll just leave you with this one thought. A company's financials, they're a history book. They tell you with perfect clarity what has already happened. But the people, the leadership, the culture, this whole second dimension, that's a crystal ball. It gives you clues about the future. So the question is, the next time you look at a company, are you just going to see the numbers, or are you going to see the people who create them?
You know, when you're looking at a company, it's easy to focus on 2 things, right? The quality of their products and the strength of their management. But what if I told you there's a third, almost hidden dimension? This is the thing that really separates the good companies from the truly great long-term investments. So what is this elusive quality? Well, let's peel back the layers together and find out what makes all the difference.
There's this brilliant analogy from the investing legend Philip Fisher. He said, a highly profitable company is just like an open jar of honey. It's sweet, it's irresistible, and it basically sends out an open invitation for competitors, the hungry insects, to come swarm in and take their share. And that, right there, sets up the fundamental problem every single successful business has to solve.
And this lays out that cycle perfectly. A company strikes gold, right? It finds a really profitable niche. But that success acts like a giant beacon, attracting all these rivals who naturally want a piece of that action. So as more and more competitors pile into the market, they all start fighting for sales, which almost always drives down the very profits that attracted them in the first place. It's this inevitable loop, and every great company has to find a way to break it.
So here's the game plan for this explainer. We're going to start by really digging into this honey jar problem. Then we'll define the elegant solution, what Fisher called the third dimension. From there, we'll explore its 3 most powerful forms: the brute force of scale, the genius of uncopyable technology, and the subtle brilliance of a sales moat. And we'll wrap it all up with the one key question you should be asking before making any investment.
Okay, let's really dig into this core challenge. Why are profits, the very lifeblood of a company, constantly under siege? It's not just about rivals trying to undercut you. It actually comes down to a subtle but really crucial difference in how we measure profitability, and what those numbers really tell us about how resilient a company is. Now this is where it gets interesting. Think of it this way. Return on assets. That's what a manager uses to see if their factory machinery is running efficiently. It's an internal thing. But for us as investors, the profit margin on sales is the real tell. That's our metric for safety. It's like measuring the thickness of the castle walls, telling us just how much of a cushion a company has with every single dollar it brings in.
And that cushion, man, it is never more important than during tough times. Picture this. Inflation hits, and costs go up by 2% for every company in an industry. Now, the business with a 10% profit margin, sure, it feels the pinch, but it's still making good money. But what about the company with only a 1% margin? Boom, it's suddenly losing money. It could get wiped out.
That high margin is a powerful, powerful defense.
So if high profits are this open jar of honey just begging for competition, how on earth does a company protect it? Well, this brings us to the solution, what Fisher called the third dimension. It's all about building a barrier, a protective wall around that honey.
And it is so important to get this right. We're not just talking about having a superstar CEO or a hot product for a year or two. Those things can be temporary. The third dimension is something that is baked into the very structure of the business itself. It's an inherent, durable characteristic that allows it to maintain superior profitability year after year after year. It's a fundamental structural advantage.
So why do we care so much about this sustained profitability? Well, because it's the engine that powers literally everything else. It's the cash that funds the R&D and the innovation for new products. It finances the new factories and equipment to build them. It covers the cost of growth, like more inventory and receivables. And, as we just saw, it provides that critical financial shield against rising costs. Without it, a company is just stuck. It stagnates.
Okay, let's break this down. Let's get into the first and probably the most common characteristic of this third dimension, the raw power of scale. This is all about having a size advantage that your competitors just can't touch.
This chart just nails the core concept beautifully. A well-run industry leader, the one pumping out millions of units, can almost always achieve a much lower cost for each one than a smaller rival can. And that cost advantage, that's a massive competitive weapon. It lets them either pocket more profit or drop their prices to grab even more of the market.
I mean, just look at business history. It's filled with examples of this. For decades, Westinghouse threw everything they had at General Electric and just couldn't break through. Dozens of companies, including huge ones, tried to unseat IBM back in the early days of computers, and they all failed. Once a true, competent leader establishes that dominance through scale, they are incredibly tough to displace.
And there's this really powerful psychological thing going on here too. Imagine you're a corporate buyer, and you have to pick some critical piece of equipment. If you choose the industry leader and something goes wrong, no one's going to blame you. But if you take a chance on a smaller, lesser-known company and it fails, your neck is on the line. Choosing the leader is just the safe career move, and that reinforces the leader's position over and over again.
Campbell's Soup is just a fantastic, classic example of scale in action. They're so big they can afford to make their own cans. They have plants strategically located all over the country to keep shipping costs down, which is a huge deal for a heavy product like soup. When you walk into a supermarket, they automatically get the best shelf space. And their advertising dollars go way further because they're spread across a massive volume of sales. Every single one of these is a barrier built by sheer scale.
But hey, scale isn't the only way to build a moat. While being the biggest is a powerful advantage, sometimes being the smartest in a really unique way can be even tougher to beat. So now let's explore that second key characteristic of the third dimension, creating a technological advantage that is incredibly difficult for anyone else to replicate.
This slide highlights a truly brilliant distinction. See, if your advantage is purely in one field, let's say electronics, well, there are probably a lot of other smart electronics companies that can eventually figure out what you're doing and copy you. But what if your product requires mastery of both electronics and a super specialized field of chemistry? All of a sudden, the barrier to entry gets exponentially higher. And this is exactly why it's such a killer moat. A huge electronics firm simply doesn't have the world-class chemists on staff to compete, and a big chemical company doesn't have the cutting-edge software and hardware engineers. So the innovator who masters that intersection of different scientific fields, they create this protected space where very few can follow, and that lets them sustain high profits for years, sometimes even decades.
All right, this brings us to our third characteristic, and honestly, this one is maybe the most subtle and clever of them all. This is about more than just having a great sales team. It's about structuring your business and your market in such a way that it's not just difficult for competitors to steal your customers, it's completely unprofitable for them to even try. Now, for this powerful sales moat to exist, a very specific set of conditions has to be in place. It's like a recipe. First, the product has to be absolutely vital to the customer. Second, it has to be a tiny fraction of their overall budget. Third, the company needs to be the dominant go-to name in the space. And finally, this is critical, they must sell to thousands of small, specialized customers, not just a few big ones.
And here's the punchline. Here's where the economic trap snaps shut. Because the customers are so small and specialized, you can't reach them with broad advertising. A competitor would literally have to send a salesperson out to make a direct call. But, and here's the genius, since each order is so small, the cost of that sales call would be more than the profit they could ever make from the sale. It makes competition economically irrational. It's an absolutely brilliant self-defending business model.
So we've looked at the problem, the honey jar. We've looked at the 3 pillars of the solution. Now let's tie this all together into one final actionable takeaway you can use in your own analysis.
2%. What in the world does this number mean? I mean, it seems so small, almost insignificant, doesn't it? But this little margin, this is actually the secret to the entire concept we've been talking about. It's the key that unlocks a truly sustainable competitive advantage.
Remember the honey jar? A spectacularly high profit margin, that's actually a huge danger. It's too sweet, it's too tempting, it invites a flood of those hungry insects. So the crucial point is this: the goal isn't some massive, unsustainable margin that just paints a target on your back. A small, consistent, and, most importantly, defensible 2 or 3% edge over your nearest rival, that is all it takes to build a truly outstanding long-term investment.
And that brings us right here, to the very end. When you are looking at any business, this is the ultimate question you have to ask yourself. What can this particular company do that others would not be able to do about as well? If you can't find a convincing answer, if there is no obvious scale advantage, no unique technology, no clever sales moat, then you probably haven't found a company with a true third dimension. But if you can answer it, you may have just found the key to a truly uncommon investment.
Have you ever sold a stock only to watch it just take off like a rocket? Or maybe you've bought a stock that seemed so cheap, a real bargain, and then it just kept getting cheaper? Yeah, you're definitely not alone. In this explainer, we're going to dig into the hidden force that really drives stock prices, and it's a concept that could completely change how you invest, for the better.
Let's just kick things off with a pretty sobering fact. Billions, maybe even trillions of dollars have been lost by really smart people, well-meaning people, who all made the exact same fundamental mistake in the stock market, over and over and over again. And all of that financial pain, it almost always comes from getting confused about one of the most common, but also one of the most misunderstood numbers in all of finance. So what is this number that trips up so many investors? Well, let's take a closer look. Yep, we're talking about the price-to-earnings ratio. You've probably heard it called the PE ratio. And on the surface, it seems so simple, right? It's just the price divided by the earnings. But what it really means and how people use it and abuse it, that's the source of some really deep and often very, very expensive confusion. All right, so here's our game plan for the next few minutes. We're going to walk through these 5 stages. We'll start with that billion-dollar mistake. Then we'll uncover a kind of secret law in the market, break down the difference between perception and reality, see how this whole thing creates fortunes and failures, and then finally, we'll build a completely new way for you to think about risk. So what is this big mistake that costs investors so much? Well, it's kind of like a two-headed monster. On one hand, you've got people buying stocks that look cheap but are actually just traps. And on the other, you have people selling truly great companies way too soon, leaving huge amounts of money on the table. Both of these mistakes come from a really flawed idea about that PE ratio. You know, we've all heard that classic advice: buy low, sell high. But when you apply that thinking to the PE ratio, it can be super misleading. It can trick you into selling your winners and buying into companies that are cheap for a very good reason, and that is a recipe for total portfolio disaster. This really makes you wonder, right? If a company's actual performance, its real earnings, isn't what's directly causing these huge, dramatic swings in the stock price, then what is? Well, the answer is a really powerful but often overlooked law of the market. So what is this secret law? Well, it's a principle that just cuts right through all the noise, all the daily ups and downs, and it shows you the real engine behind those big long-term price moves. Now, I want you to focus on one word here, just one: appraisal. It's not about the hard numbers, not the earnings or the revenue. It's about the financial community's collective opinion, their story about what the company's future looks like. This is where the real magic and the real danger is hiding. Okay, so what in the world is this appraisal? It's so important to get this. An appraisal is subjective. It has nothing to do with objective reality and everything to do with what people believe is real. You see, a stock goes up or down based on what investors think is going to happen. Just think about the dot-com bubble, right? You had companies with zero profits that were worth billions of dollars, all based on this big story about a new economy. That's the power of appraisal, and it can be completely disconnected from reality for a long, long time. But here's the kicker: that disconnect can't last forever. A stock can float on a cloud of hype for months, even years, but eventually gravity kicks in, reality shows up, the bubble bursts, the story falls apart, and the fall can be absolutely brutal. And what often happens next is the market overcorrects and creates a new, super pessimistic story. So how does this actually play out for investors? Well, this whole dynamic of shifting appraisals is really a powerful two-sided coin. It's the source of incredible fortunes, but it's also the cause of some truly devastating losses. This right here, this is the holy grail for investors. It's what's known as the double reward. It's what happens when a company's actual business is improving and the market finally wakes up and realizes it. It's like pouring gasoline on a fire, and it can lead to some absolutely explosive gains. Let's make this real with an example. We'll call it Company G. 2 years ago, it was just an ordinary company, earning $1 per share and trading at a PE of 10. But then, 2 years later, through some brilliant work, its earnings grew to $1.82. Now that's a nice 82% increase. But look what happened to its appraisal, the market's opinion, that PE ratio. It more than doubled, from 10 all the way to 22. So let's do the math here. The earnings went up 82%, but the stock price quadrupled, from $10 to $40 a share. How's that even possible? It's because the change in the appraisal, the market's perception, was an even more powerful force than the company's actual growth. That is the power of the double reward. But, and this is a huge but, this is a double-edged sword. When a company's glamorous story crashes into a harsh reality, the collapse can be just as breathtaking on the way down. We've seen it time and time again with these high-flying stocks that come crashing back to earth. When that story breaks, the investors who bought into the hype, well, they're the ones who get burned. Okay, so what do we do with all this? How does it actually help us? Well, understanding this dynamic lets us build a much smarter framework for thinking about investment risk. See, it's not just about how good the company is. It's about how good the company is compared to the story the market is telling about it right now. Now, this slide, this is really the key to putting it all into practice. It's a whole new way to think about risk. Just look at the top row, the sweet spot. The absolute lowest risk investment is a fantastic, high-quality company that the market is currently down on. Its appraisal is lower than it should be. That's where you find the potential for that amazing double reward. Now, look at the bottom. What's the most dangerous group? It's not necessarily a bad company. It could be any company where the appraisal, the story, has run way, way ahead of the facts, where expectations are so high they're basically impossible to meet. That's the cliff edge. And here is a lesson that so many great investors have learned the hard way. If you are lucky enough to find a truly exceptional company, one with a really long runway for growth, selling it just because the market gets a little too excited for a while, well, that can be a massive mistake. So why is that? Why not just lock in the profits? Because finding another truly great business is incredibly hard. It's like finding a needle in a haystack. The risk of selling your winner to buy something that looks good but really isn't is often way greater than the temporary risk of just holding on while the business grows into its higher price tag. So what's the bottom line here? It's this. You have to learn to see the two sides of every investment. There's the business itself, the nuts and bolts of what it does, and then there's the stock, which is really just a reflection of the market's constantly changing opinion about that business. Your job is to stay focused on the business, not on all the noise. So the next time you're thinking about buying or selling a stock, I want you to ask yourself this one simple question. Am I investing in the company, or am I just betting on the crowd's opinion? Answering that question honestly, well, that could be the difference between long-term success and a whole lot of costly mistakes. You know, we think we invest in companies, right? We look at their balance sheets, their products, their management. But what if I told you that a lot of the time what we're really investing in is just a story that Wall Street is telling itself? Well, today we're going to pull back the curtain on that story, what you could call investing's hidden fourth dimension. All right, so here's how we're going to break this down. First, we'll define what this fourth dimension really is. Then, we'll see just how powerful perception can be, how it literally shapes reality in the market. After that, we'll jump into some classic, real-world examples to see it in action, and we'll wrap up with what all of this really means for you. Okay, first things first, we need to tear down a really common and kind of dangerous oversimplification about how stocks are actually valued. And to do that, we have to start with one simple question. I mean, it seems like a no-brainer, doesn't it? A great company with great products should obviously be a great stock to own. But as you're about to find out, the real answer is, well, a whole lot more complicated than that.
And this right here gets to the absolute heart of it. A stock's price isn't figured out in some sterile lab. It's influenced by these huge, powerful forces. It's kind of like trying to predict the weather. You can't just look at the thermometer outside your window. You got to look at the regional weather patterns, even the global jet stream, to really know what's coming.
Now, this is where it gets really interesting. As investors, we spend almost all our time, all our energy obsessing over number 3, picking apart the specific company. But so often, the biggest, most powerful, and frankly, the most irrational force pushing a stock around is actually number 2. The collective story, the narrative, that the market has decided to believe about that company's entire industry. So let's really dig into this core concept. How is it that the story, the whole narrative around an entire sector, can do a complete 180, even when the fundamental facts about the businesses themselves haven't changed one bit? This industry image idea is everything. We're not talking about sales going up or down or profits changing. We're talking about the giant spotlight of Wall Street suddenly swinging across the stage and deciding to shine on a completely different set of facts, leaving the old ones in the dark. And this lays it out perfectly. It really captures the main point from our source material, which says what had shifted was the emphasis, not the facts. Think about it. The good things and the bad things about an industry are almost always there, side by side. What changes is which of those things the market decides to care about this year. Okay, enough theory. Let's look at a perfect, real-world example of this whole thing in action. For decades, the chemical industry was the poster child for this kind of shifting story. I mean, just look at this roller coaster. The story that got told about the exact same industry changed so dramatically, and it dragged stock prices right along with it. They went from being Wall Street's darlings, the engines of innovation, to being seen as boring, old commodity producers, and then back again to being a hot scarcity play. The narrative was constantly changing. And right here, you can see how that perception translated directly into cold, hard cash. By the time the 1960s rolled around, the valuations for chemical companies, that's their PE ratio, basically how much investors will pay for $1 of profit, had tanked. They looked just like old-school, boring industries like steel and paper. The story changed, and so did the price tag. And here's the real kicker. Nothing fundamental had actually changed. The chemical industry was always both things at once, a high-tech engine of innovation and a capital-hungry commodity business. Back in the 40s and 50s, the market just chose to ignore the bad parts. Then, in the 60s, it chose to ignore the good parts. The story was always just a selective version of the truth. Now, you might be thinking, okay, that's a weird one-off with the chemical industry. But it's not. This pattern of a shifting narrative, a market mood swing, it happens over and over again. Let's fire through a few more quick examples. So let's hop in the time machine and go to 1969. The story for computer peripheral stocks was all hype. The narrative was that these small, scrappy companies making add-ons for the big mainframe computers were the future. They were David versus Goliath, and David was winning. But then, the story changed. Suddenly, the market started focusing on the facts it had been ignoring, the incredible financial pressure of having to lease your products instead of selling them outright. And, oh yeah, the fact that giants like IBM weren't just going to roll over and play dead. The narrative flipped from boundless opportunity to massive risk. We saw the exact same movie play out with franchising stocks. First, you had this huge boom. The story was simple, it was exciting, rapid, cookie-cutter growth. But that was followed inevitably by a bust when the story shifted to focus on all the problems that had been there from the start, like quality control nightmares and oversaturated markets. Now, this next case is absolutely fascinating. A.C. Nielsen, the market research company. Back in 1958, this was a totally alien concept for the market. It was a service business. There were no factories, no inventory, nothing you could physically touch. So how on earth was Wall Street supposed to figure out what a company that just sold information was worth? This quote just perfectly captures that feeling of profound uncertainty. You are basically betting on a whole new business model, a completely new story with none of the old comfortable ways of measuring value. It must have been terrifying. But then, as it so often does, the pendulum swung way too far in the other direction. The
The market went from total skepticism to blind enthusiasm. A new, dangerously simple story was born. Service industries are great. And this led to all sorts of totally different companies being lumped together under this one trendy label, with many of them getting crazy high valuations they hadn't earned at all. The story just got too simple.
Okay, let's bring this all home. In this last section, let's focus on the big takeaway. What does all this history mean for how we should approach investing right now, today?
So what does it all boil down to? It means your job isn't just to be a financial analyst. You have to be a story critic. You need to really understand the story the market is telling about an industry, and then you have to ask the hard questions. Is this story true? Is it the whole story? And most importantly, what critical facts is this popular story choosing to leave out?
And this is the core lesson right from the source. Your job isn't just to analyze the company. Your job is to analyze the analysis. You have to understand the story that everyone else is buying into, and then constantly be probing, constantly asking if that story is really more positive or maybe more negative than the facts truly justify.
And that brings us to the final thought I want to leave you with. Take this lens and apply it to the market today. Which industries are the darlings right now? Which ones are in the doghouse? And is the story that Wall Street is telling about them the whole story? If you start looking at the market this way, you might see things very, very differently. Welcome. If you've spent any time at all looking at stocks, you have definitely come across the PE ratio, the price to earnings ratio. It's everywhere, right? It's presented as this simple, almost magical shortcut to tell you if a stock is a bargain or if it's way too expensive. And, for years, I've watched so many investors, brand new ones and seasoned pros alike, just lean on it like a crutch. But here's the truth. This simple little tool is one of the most misunderstood and, frankly, misused metrics in all of finance. So today, we're going to deconstruct it. We're going to see exactly why it leads people astray so often, and we're going to uncover a much, much more powerful way of looking at a company's real value. Okay, so here's our game plan. We're going to start by looking at the PE ratio trap and why that number that looks cheapest isn't automatically the best deal. Then we'll dig into the real engine of long-term value, what I'm calling growth's secret ingredient. From there, we'll jump into a fantastic real-world case study with Motorola from back in the 70s that just perfectly illustrates this whole idea of perception. That story will then lead us right into a chat about the dangerous investor psychology that trips up even the smartest people. And finally, we'll put all these pieces together into a solid framework for appraising the full picture and investing in what our source material calls the fourth dimension. All right, let's start with the trap itself. It's so easy to fall into this thing because it just feels so logical. We're all taught to look for a good deal, right? To buy things when they're on sale. The PE ratio seems to offer exactly that, a simple price tag for a company's earnings. But as we're about to see, treating the stock market like it's a grocery store and just hunting for the lowest price tag, well, that can be a recipe for absolute disaster. So picture this. You're faced with a choice. You've got company A trading at 10 times its annual earnings, and you've got company B trading at 20 times. Now, if that's all you knew, the knee-jerk reaction is obvious, isn't it? You're paying half as much for every single dollar of company A's profit. It feels like the sensible, prudent, clear-cut bargain. It's the one you'd circle on the page without even thinking twice. But is it really the better investment? Here's the thing. That single number, completely stripped of any context, is almost meaningless. In fact, more often than not, it's actually a warning sign. A low PE can signal that the market has incredibly low expectations for that company's future. The so-called cheap stock might just be a business in decline, a value trap just waiting to spring on you. That more expensive stock, on the other hand, well, it might be priced that way for a very, very good reason. So, this gets us to the real heart of the matter. The single most critical factor that determines what a company is truly worth over the long haul, it isn't just its growth rate next quarter or even next year. No, it's the duration of that growth. For how many years can the company keep growing at an attractive pace? This is the fundamental question, and believe me, it is the key that unlocks this entire PE puzzle. Okay, let's go back to our two companies. Imagine that for the next 4 years, both of them are just on an absolute tear. They've got great products, they're grabbing market share, and they both managed to double their earnings. From this short-term view, they look like identical twins. An investor looking at just this little snapshot in time would think, wow, these are very similar businesses. But now we have to look further out. This is where the paths just completely diverge.
In years 5 through 8, Company A just hits a wall. Maybe its product was a fad, maybe a bigger competitor came in and crushed them, its growth stalls, and its earnings totally flatten out. Company B, on the other hand, has some kind of durable competitive advantage. It keeps innovating and it manages to double its earnings again. The raw power of that compounding completely separates it from its peer, and it reveals exactly why its higher initial PE might have been the real bargain all along.
And this brings us to a foundational rule of smart investing. This quote on your screen, it says it all perfectly. You see, you're not just buying a company's earnings today, you're buying a claim on all of its future earnings. So if you have really high confidence that a business can keep growing its profits for 10, 15, even 20 years, well, then you can logically afford to pay a much higher multiple for those earnings today than you would for a company whose future is just murky or stagnant. Okay, let's move from theory to a real-world example to see exactly how this plays out. This isn't just some textbook concept. This happens all the time. We're going to go back to 1974 for a really fascinating story about Motorola, which shows just how violently the market's perception of a company and its price tag can shift when new information about its long-term future comes out. I mean, just check out these numbers. On Tuesday, March 12, 1974, Motorola stock closed at just over $48 a share. The very next day, Wednesday the 13th, it closed at $60. That is a staggering jump of nearly 25% in a single day. The value of the entire company increased by hundreds of millions of dollars in just a few hours. So you have to ask yourself, what could possibly happen overnight to make a huge, established company suddenly worth a quarter more than it was the day before? I mean, did they invent a time machine? Announce some massive world-changing contract? Well, the actual reason was way more subtle, and it has everything to do with the story the market was telling itself about Motorola. Here was the catalyst. The big news was that Motorola was selling its television manufacturing division to Matsushita, the company we now know as Panasonic. Now, on the surface, this might not seem like a huge deal. The TV business was a pretty small part of Motorola, and it was known to be a drag on profits, but selling it, that alone could not mathematically justify that massive leap in the stock price. Something much bigger was going on under the surface. So here's the crucial point. The sale wasn't just an accounting move. It was a clarifying event. It completely changed the financial image of the entire company in the minds of investors. For years, people had mentally lumped Motorola in with all the other consumer electronics companies, viewing it as this also ran in the brutal, low-margin TV business. By shedding that division, the true nature of the company was suddenly revealed. It was a high-grade, technology-leading communications powerhouse. All at once, the market saw the real, high-duration growth engine that had been hidden in plain sight, and it repriced the stock in a flash to reflect that new reality. And this Motorola story does more than just teach us about growth. It shines this huge, glaring spotlight on a dangerous psychological bias that affects every single one of us. It's a mental shortcut our brains just love to take, and it's one of the most subtle and costly traps in the entire world of investing. It's a cognitive bias known as price anchoring. This is our powerful, almost irresistible subconscious tendency to get mentally latched onto a certain price or price range that we're familiar with. We see a stock trade in a certain channel for a while, and that range becomes our mental benchmark for what it's supposed to be worth, no matter what's actually changed with the business.
Think about it like this. If you've been watching a stock trade consistently between, say, $38 and $43 for a whole year, and then some bad news hits and it plunges to $24, your gut instinct just screams, it's on sale, it has to go back up. But that anchor to the old price, it's totally irrelevant. The only thing that matters is what the business is worth today, based on its new, possibly damaged future. That past price is just a ghost.
So if we can't rely on simple PE ratios, and we have to constantly fight our own psychological biases, like anchoring, how do we make smart decisions? Well, the key is to avoid shortcuts altogether. A shrewd investor knows they have to appraise the whole situation on 3 distinct levels. You have to build a complete mosaic of understanding, not just stare at 1 or 2 shiny tiles.
First, you have to go deep on the company itself. This is your classic fundamental analysis. The balance sheet, the management team, its competitive advantages. Second, you have to pull the lens back and assess the industry it's competing in. Is it a growing industry with tailwinds, or is it a shrinking one with major headwinds? And third, you have to step back even further and just judge the general market's overall mood. Is there total euphoria in the air, or is there blood in the streets? Now, the importance of that third layer, market psychology, it cannot be overstated. Just think about the historical extremes. In the late 1920s, the mood was one of new era optimism. The belief was that stocks were on a permanently high plateau.
That mood was, of course, spectacularly wrong. And you can contrast that with the late 1940s, when this deep post-war pessimism had set in. Everyone was just waiting for another Great Depression. That mood was also spectacularly wrong, and it ended up setting the stage for one of the greatest bull markets in history.
And when you learn to skillfully blend these three appraisals, the company, the industry, and the general market, you unlock what the source material for this explainer calls the fourth dimension of investing. Now, this isn't some mystical concept. It's really the pinnacle of the analytical process, and it's where the most profound investment opportunities are always hiding.
So what is this fourth dimension? Well, it's simply the gap between perception and reality. It's the difference between the story Wall Street is telling about a company, its financial image, and the cold, hard facts of the business and its true long-term prospects. The greatest fortunes are made by investors who can correctly identify when that gap is at its widest, when the market story is most divorced from the underlying truth. So, let's bring this all together. What are the crucial points to take away from all this? First, please start treating the PE ratio not as a final answer, but as the very first question in a long line of questions. Second, burn this into your brain. The longevity of a company's growth is far more important than a temporary high growth rate. Third, understand that the most fertile ground for opportunity is always in that gap between perception and reality. And finally, be ruthlessly disciplined about fighting that powerful urge to anchor your idea of value to a stock's past price.
And that leaves us with one final thought. A challenge for you, really. Think about a company you know well, one you follow closely. Try to articulate the market's current story about it. What is its financial image today? Is it seen as a growth darling, a stodgy old dividend payer, a turnaround story? And then, do the hard work. Dig into the facts. What is its underlying reality? The answer you find in that gap, well, it might just be your next great idea.
All right, let's talk about a true giant of investing, Philip Fisher. Today, we're digging into how his famous growth philosophy came to be. And here's a spoiler. It wasn't cooked up in some comfortable classroom. Nope, it was forged in the fire of trial, error, and some pretty spectacular failures. This is the story of how the painful, hard-won lessons of the Great Depression created an investment framework that's still shaping markets today. Let's get into it.
You see this quote? This one idea. It's the key to everything. You have to remember, at the time, Wall Street was completely obsessed with what a company was earning right now, today's stock price. Fisher comes along and says, you're all looking at the wrong thing. He was looking years down the road. I mean, what a radical idea. So how in the world did one man develop such a powerful and frankly contrarian point of view? Well, that's the journey we're on today.
And this is what that forward-looking idea built. A philosophy that is so focused, so disciplined, it's not about spreading your money all over the place just to be diversified. It's about making a concentrated bet on just a handful of truly exceptional companies. And look at the key words here: superior management and a willingness to lock past short-term bumps for long-range growth. This became the absolute North Star for his entire career.
But here's the thing you have to understand. This elegant philosophy, it didn't just pop into his head one day. Fisher himself said it was built piece by piece through what he called the more painful method of learning from my own mistakes. And believe me, some of those mistakes were brutal. It's a journey that starts way before Wall Street, with a simple conversation he overheard as a kid. So where does a mindset like this even come from? For Phil Fisher, the origin story doesn't start with a stock ticker. It starts with plain old curiosity. To really get the investor he became, we have to go back and look at the young man and the world that first grabbed his attention.
The first spark was lit when he was just a kid in grammar school, listening to his uncle and grandmother talk about stocks. Can you imagine? Suddenly, this whole new world opens up, this idea that you can actually own a piece of a business. Now, sure, he dabbled a bit in the roaring 20s bull market, made a few bucks, but looking back, he said those early wins taught him almost nothing of any great value. The real turning point where his education truly began was when he got into Stanford's brand new Graduate School of Business. And at Stanford, there was this one course that changed everything for him. It wasn't about lectures or textbooks. This professor, Boris Emmett, was an expert at turning around struggling companies. And every week, he would take his students out to visit real businesses in the Bay Area. Fisher, being a pretty smart guy, offered to be the professor's personal driver. Just think about that. He got a front row seat, not just in the meetings, but for the real, unfiltered analysis on the drive back to campus. And the lessons he learned from Professor Emmett were game changers.
It wasn't enough to just tour a factory and see the wheels go around. You had to dig way, way deeper. You had to truly understand the management team's strengths and, just as important, their weaknesses. And this is where one of the first pillars of his philosophy started to form. A brilliant product is totally worthless if you don't have a powerful sales organization to back it up. Without that, a company could never, ever control its own destiny. So, armed with this incredible real-world wisdom, Fisher leaves Stanford a little early for a job on Wall Street. The year? 1928. He was, without knowing it, walking directly into the last crazy, feverish days of the biggest bull market in history, and he was about to get the most painful and most important education of his entire life. Get this, his first job title was statistician. You don't hear that term anymore, do you? Well, there's a reason for that. After the crash of '29, the work these statisticians did was held in such low regard that the whole industry had to rebrand the job to security analyst. Fisher found out why pretty quick. He flat out called the work intellectually dishonest. I mean, the standard method back then was a joke. You just copy some data out of a financial manual like Moody's, and if it was a big company, you'd just slap a well-managed label on it. No original thought, no real investigation. Fisher knew this was garbage. So, with radio stocks being the hot thing everyone was gambling on, he ran a little experiment. Instead of reading manuals, he went out and actually talked to people who knew what was going on. Department store buyers, engineers, you name it. And he got the real story. He found out Philco was innovating like crazy, RCA was basically treading water, and one of the market's big darlings was secretly in a whole lot of trouble. And that one experience, that little bit of detective work, is cemented the first great pillar of his entire philosophy. The printed numbers, the official reports, that's just the tip of the iceberg. They are never, on their own, enough to justify putting your money into a company. To really understand a business, you have to get out there, you have to talk to people, the customers, the suppliers, even the competitors. So as 1929 rolls on, Fisher is getting more and more nervous. He's looking at America's big industries and he's seeing cracks everywhere. The fundamentals just looked wobbly. And then in August of 1929, he writes this report for the senior partners at his bank with this just stunning prediction. He saw the crash coming with absolute terrifying clarity. I mean, think about that. He completely, totally nailed it. This is one of the greatest market calls in history, and it's made by a kid in his early 20s. So the obvious question is, did he make an absolute fortune from this incredible foresight? Did he protect himself and clean up when the market collapsed? Well, the answer, as he put it himself, was quite the contrary. It's incredible. Even though he knew the whole market was a house of cards, he was still sucked in by the siren song of a so-called bargain. He took his own money and put it into 3 stocks that looked cheap because they had low price-to-earnings ratios, and the market taught him a brutal lesson. The locomotive company? Super cyclical. Its profits completely evaporated in the Depression. The billboard and taxi cab companies? They were just fundamentally bad businesses. He learned the hard way that a low PE isn't a bargain sign. It's often a warning label. By 1932, his savings were almost totally wiped out. But here's what separates the legends from everyone else. Fisher absolutely hated losing money, and that hatred forced him to go back and dissect every single one of his failures. He realized being right about the big picture, the market, had done him zero good because he'd been dead wrong about the actual businesses he owned. He learned that a low PE is often a trap, and this painful, expensive lesson became the tuition for his greatest education. So, after the crash, Fisher lands at a different firm. But the bear market just keeps grinding on, and that company gets into trouble too. Right before Christmas in 1930, his employer gets suspended from the stock exchange. They were broke. So here he is, out of a job in the absolute depths of the Great Depression. You'd think it's a total disaster, right? Well, it turned out to be the single most fortunate thing that ever happened in his career. With no good jobs out there, he had no choice but to start his own investment firm. And it sounds crazy, right? Starting a business in 1931, but it turned out to be the absolute perfect time to do it. Why? Well, 2 reasons. First, pretty much every investor was so disgusted with their old brokers that they were actually willing to listen to this young guy with a completely different approach. And second, with the economy at a dead stop, incredibly powerful CEOs and business leaders, they actually had time to take his calls. Now, it was anything but easy. He rented this tiny windowless office, and after he paid his $25 a month in overhead, his books for the entire year of 1932 show an average net profit of $2.99 a month. Just think about that.
The sheer grit required to stick with it on that kind of money is just, it's astonishing. Things did get better in 1933. In fact, his profits shot up by almost 1,000%, all the way up to $29 a month. As he used to joke, it was about what he could have made selling newspapers. But the real profit wasn't the money. He was building the foundation, earning a small, core group of fiercely loyal clients who would end up staying with him for their entire lives. And so, through this entire journey, from that hands-on class at Stanford, to the intellectually bankrupt work on Wall Street, to the brutal personal losses of the crash, and the absolute grind of starting a business from nothing, the core principles of the Philip Fisher philosophy were finally hammered and forged into one coherent, powerful whole. So, let's just boil all that experience down into his 5 cornerstones. Number 1, go beyond the printed financials. That comes directly from his investigation into the radio stocks, where the real story wasn't in the reports. Number 2, talk to people in the know. That's his famous Scuttlebutt method, born from those interviews with department store buyers. You have to find the customers, the competitors, the real experts. 3 and 4, they come straight from Professor Emmett's real-world lessons. You have to evaluate the management team, not just for competence, but for integrity and vision. And you have to judge their sales strength, because the idea that a great product sells itself is a complete myth. And finally, number 5, the biggest lesson of all, learn from the ashes of his 1929 failures. Project future earnings. Your focus has to be on where the business will be in a few years, not where it is right now. When you put it all together, the crucial takeaway, the big idea, is this. Philip Fisher was spectacularly right about the market in 1929, and it did him absolutely no good. He lost his money because he owned weak businesses. His entire life's work, then, became a testament to this powerful idea. True, lasting investment wisdom isn't about predicting the market's crazy swings. It's about the deep, patient, hard work of understanding individual businesses.
And that really leaves us with one last question to think about, a challenge from Fisher's philosophy to our own. When we look at an investment, or heck, any big decision in life, are we getting hung up on yesterday's story? Are we just focused on last year's price or last quarter's news? Or are we willing to do the hard work, like Fisher, to really try and understand what the story of tomorrow is going to be? Thanks for tuning in.
You know, some of the absolute best investment lessons, they're not found in some fancy spreadsheet. Nope, they are forged in the fire of market history. And today, we're going to go back in time, all the way back to the dawn of the Great Depression, to learn from a true master, Philip Fisher. We're going to explore how one painful mistake and just one, once-in-a-lifetime opportunity shaped an investment philosophy that's still incredibly relevant today.
So picture this. The year is 1928. We're in San Francisco. And the air, it is just thick with this speculative mania. The stock market is absolutely roaring, and new companies are popping up left and right. And everybody, I mean everybody, is scrambling to buy in, totally convinced they're on the fast track to a fortune. It's the classic bubble, where the hype has completely, totally overshadowed any substance.
Philip Fisher, who was just a young analyst at the time, he saw this danger firsthand. He later wrote that, and I'm quoting here, "The lack of soundness of some of these issues was little short of appalling." He even told a story about one firm that was selling shares in a bottled water company with basically nothing more than a photograph of the spring it was supposed to come from. Can you imagine? It was just an environment where any new stock was seen as a winning lottery ticket, no matter what the actual business behind it looked like.
And that really brings us to the central question, doesn't it? When everyone around you is gambling on hype and momentum, how do you cut through all that noise? How do you actually find a truly great company? You know, the kind of investment that can literally change your financial life. Well, as we're about to see, Fisher found the answer by looking where nobody else was, at a company born right in the middle of all this chaos.
So our story kicks off with the birth of a company called Food Machinery Corporation. It came together in 1928 through a merger, and really, in the public's mind, it was just another one of these exciting new stocks of the year. Nothing special, not better or worse than any of the others.
What's so fascinating here is just how perfectly this timeline captures the madness of that era. So the stock comes out at $21.50. Then, these things called pools, which were basically legal manipulation schemes back then, they drive the price way up into the high 50s. And then, the crash hits, and by 1932, the stock has completely collapsed to a low of just $3.75. The public, who couldn't get enough of it before, now saw it as just another piece of speculative junk.
But here's the thing. Where the market saw junk, Fisher saw something else entirely. See, he'd been burned before by not doing his homework, and he was determined not to make that same mistake twice. He decided he was going to dig deeper, to really truly understand the business behind the stock ticker. And what he found? Well, it became the blueprint for the kind of opportunity he would hunt for the rest of his career.
So the first layer of his analysis was the business itself. And this right here, this is its foundation. Food machinery wasn't some flimsy idea. It was a world leader in its specific niches. That scale gave it a huge advantage, making it a low-cost producer. On top of that, it controlled its own sales organization, which is a massive plus. And best of all, it had a locked-up market. Think about it. All those machines already out there created this constant, super reliable stream of revenue from spare and replacement parts. It's brilliant.
But look, a solid foundation is only half the story. The second layer Fisher uncovered was all about innovation. He found this incredibly creative engineering department that was on the verge of releasing some real game changers. The first ever mechanical pear peeler, the first ever peach pitter, and even a brand new process to make oranges look more appealing. This pipeline of new products was so huge compared to the company's size, it had the potential to completely transform its future.
And this brings us to what Fisher considered maybe the most critical piece of the puzzle: the quality of the people. Now for him, this wasn't some vague idea. It boiled down to two very distinct things: raw business ability and something much, much deeper: integrity.
And he broke down business ability even further. He said a company needs management that's great at the day-to-day stuff, improving production, watching the books, all the little details that keep a business humming. But it also needs leaders with long-range vision, people who can chart a course for massive future growth. Lots of companies have one or the other. The truly great ones, they have both.
But all the business skill in the world means absolutely nothing without integrity. Fisher had just seen too many cases where clever managers got rich at the expense of their own shareholders. He believed that if management doesn't have a genuine sense of trusteeship, this feeling that they are stewards of your capital, then sooner or later, you, the investor, are not going to get what's fairly yours. For Fisher, this was a total deal breaker, non-negotiable.
So, armed with this deep, three-layered understanding of the company, its business, its innovation, and its people, Fisher started to develop a core philosophy. And it was all about having the knowledge and, more importantly, the conviction to go against the crowd.
And here it is, right from the man himself. The biggest rewards, they don't come from following the herd. They come from correctly zigging when everyone else is zagging. I mean, the only reason food machinery stock was available at that ridiculously low price was because the entire financial community had written it off. No one else had bothered to do the hard work to see its true underlying value.
Fisher felt this opportunity so deeply, so profoundly, that he would actually repeat this quote from Shakespeare to himself to kind of steel his determination. He knew he was looking at one of those incredibly rare moments, a tide that, if you catch it just right, could lead to a fortune. This was the kind of thing that could build an entire career.
But, and this is a huge but, here's the critical warning label on that philosophy. Just being a contrarian for the sake of being contrary, that is a recipe for disaster. You don't just have to be different, you have to be right. As Fisher pointed out, buying up all the stocks of streetcar companies just because everyone else thought the automobile was the future would have been an epically bad move. You only zig against the crowd when you have strong, factual reasons to believe that crowd is wrong. So how do you keep yourself honest? Right? How do you know if your zigging is the correct move or just you being stubbornly foolish? Fisher created a simple but really powerful discipline for himself and his clients, the 3-year rule. He'd tell them, look, don't judge my results in a month or even a year. Give me 3 years. If I haven't produced worthwhile results for you by then, you should fire me. And man, this rule was really put to the test years later with an investment he made in a little company called Motorola. Fisher bought the stock, totally convinced of its potential in mobile communications. But for over a year, the stock did nothing. It just drifted downwards. One of his biggest clients got so frustrated he wouldn't even say the company's name. He just called it, "That turkey which you bought me." And this chart shows you exactly why that 3-year rule is so important. Look at it. The first year was negative. The second year was basically flat. It just took time for the market to wake up and see what Fisher saw. But once it did, once the company's strengths became obvious, the stock became a spectacular performer. It ended up outperforming every other stock in that frustrated client's portfolio. Patience, when it's backed by solid research, pays off. Big time.
Now let's switch gears a little and look at another powerful lesson Fisher learned. And this one came from contrasting his successful long-term approach with a short experiment in trying to time the market.
So because of all his deep work on food machinery, Fisher learned a ton about the cyclical canning industry, and he decided, hey, let me try some in-and-out trading with another company, California Packing. He actually made a profit 3 times in a row, but when he looked back on it later, he realized how silly the whole thing was. The long-term investment in food machinery took a huge effort up front, but then it was just a matter of monitoring. The trading, though, that required constant work. And more importantly, the risk was way higher. I mean, being right 3 times just increases the odds you'll be disastrously wrong on the 4th. And the final reward? The trading profits were tiny, just insignificant, compared to the life-changing gains from just holding a great company for the long haul.
Okay, this final lesson that Fisher learned it's maybe the most human one, and it's a trap that trips up countless investors. The pure folly of being stubborn over a tiny, tiny fraction of a stock's price. Oh, this story is just painful to hear. So Fisher runs into a client, tells him how incredible the outlook for food machinery is, and the client agrees, yeah, I should buy more. The stock closed at $34, so the client puts in an order to buy at $33 3/4. For the next 2 days, the stock just bounces around, always just above his price. Fisher called him twice, urging him, just raise your bid by a quarter, just 25 cents. The client refused, and the stock took off. It went up over 50% in just a few weeks, and it never came back down. He missed the whole thing.
And that gets us to the crucial point here. If you have done the work and you have real conviction that a company is a great long-term bet, do not miss a potential fortune because you were too stubborn to pay an extra 25 cents. That tiny difference is completely meaningless compared to the significant gains you can make over the long term. It's about focusing on the big picture, not haggling over pennies.
And really, that's what it all comes down to, isn't it? Philip Fisher's method, it wasn't about complex formulas. It was about doing the hard work to truly understand a business, its people, and its future, and then having the courage and the patience to act on that knowledge, especially when no one else agrees with you. So the question for all of us is, as the crowd chases today's hot new trend, are we willing to do the work to look where they aren't? Because that's where the real opportunities are so often found.
So when you hear the name Philip Fisher, you probably think growth investing, right? I mean, he basically wrote the book on it. But what if I told you his legendary philosophy wasn't cooked up on Wall Street, but was actually forged in the quiet downtime of a world at war? See, his strategy wasn't just a set of rules. It was a journey through deep research, some pretty painful mistakes, and ultimately an unbelievable amount of courage. Today, we're going to follow that journey, step by step, to see exactly how one of the greatest investment minds built his timeless framework. Let's dive in.
All right, here's our roadmap. First, we'll look at how the chaos of war actually gave him the focus he needed. Then, we're going to shadow him as he hunts for that one perfect company to test his new ideas. After that, and this is crucial, we'll dig into the hard lessons he learned from his biggest screw-ups. Then, we'll get to the real test of nerve, the courage to hold on when the world is falling apart. And finally, we'll tie it all together into a powerful framework you can think about today.
And this, right here, is the central theme. Fisher didn't just have some flash of genius one morning. No, his entire approach was hammered into shape on the anvil of experience. It was the product of deep, deliberate thinking that came from a really unique and, frankly, unexpected, quiet spell in an incredibly chaotic time.
So, where was this quiet spell? You might be surprised. It was during World War II. Fisher was a ground officer in the Army Air Corps, and his life was this weird mix of total craziness followed by long periods of, well, boredom. It was right there, sitting at a desk somewhere in Arkansas or Kansas, a million miles from Wall Street, that he took his entire investment philosophy, broke it down to the studs, and rebuilt it from scratch. And during that time, he made 3 career-defining decisions. First, he was done with the whole in-and-out trading game. From now on, his mission was to find just a few truly outstanding companies and hold on for dear life. Second, to keep himself from getting distracted, he decided he would only work with a tiny group of clients who got what he was trying to do. And third, he went all in on one industry he was convinced was the future: the chemicals. That focus, well, that changed everything.
Okay, so he's got the philosophy locked in. Now it's time for the hard part, putting it into practice. His first big mission was to find the absolute best company in that chemical industry he was so excited about. And this, my friends, is where we see the birth of his legendary research technique, something he famously called Scuttlebutt.
And this is where you can really see the genius at work. I mean, he went so far beyond just reading an annual report.
His Scuttlebutt method was all about getting out there, pounding the pavement, and talking to literally everyone connected to a company. Their distributors, their biggest rivals, their happiest and unhappiest customers, even chemistry professors and the guys who built their factories. He was basically building his own private intelligence network to get a 360-degree view you could never ever find in a spreadsheet.
So after all that digging, one name just kept popping up: Dow Chemical. And it wasn't just their numbers that impressed him, it was their culture. He found this place that was just buzzing with energy, completely obsessed with being the best and most efficient producer, and totally committed to research. But the real secret sauce he discovered was the people factor. They were fanatical about finding the best people and then just letting them go, letting them talk, argue, and create, without all the corporate red tape getting in the way.
Now get this. This quote from Dow's founder became a pillar of Fisher's own thinking. He had this huge realization. The market almost always punishes innovative companies for short-term screw-ups. A big research project would fail, earnings would dip for a quarter, and Wall Street would panic and dump the stock. Fisher saw that not as a risk, but as a golden opportunity, a chance to buy into a fantastic company run by smart, risk-taking leaders at a discount.
And this second quote was just as important. It cemented Fisher's belief that you should only own businesses that are obsessed with being the best. I mean, think about it. In a cutthroat world, just being okay is a death sentence. To get that long-term growth, you absolutely need a company that is always pushing, always innovating to keep those profit margins wide.
But Fisher's journey wasn't just a string of brilliant successes. Not at all. He always said very openly that his most important lessons didn't come from his wins. They came from his losses. He was refreshingly honest about his mistakes, and they are basically a masterclass in what not to do.
So his first really tough lesson came from a small drug company. He'd been on a hot streak, feeling pretty good about himself, when he got a tip from a medical expert he really respected. He let the story get ahead of the work, skipped his own deep dive scuttlebutt, and just bought in. Well, you can guess what happened. The drug was a bust, management was a mess, and the stock went to zero. The lesson was brutal. Success makes you lazy. The exact moment you feel like you can't lose is when you have to be more careful than ever.
Next, he got sucked into the tech bubble of the late 1960s. And look, he wasn't wrong about the company. It was a great business, a real innovator, but he got swept up in the mania and paid a price that was, frankly, just insane. And here's the wild part. The business did great, just like he thought it would. But because he'd overpaid so badly at the start, years later he barely made any money. This taught him that a great company can be a terrible investment if you pay a stupid price for it.
And his third big blunder? Oh, it was a classic case of hubris. After making a lot of money in industrial and technology companies, he started to think he was a genius who could pick winners in any field. So he wandered into consumer goods and real estate, areas he really didn't understand on a deep level, and he got burned. It's maybe the most important lesson of all. Know the limits of your own expertise. As he put it, you have to tend well the sheep at hand. Stick to what you know.
So you see how all these lessons, the wartime focus, the scuttlebutt, the painful mistakes, they were all building towards the ultimate test of his entire philosophy. Because after you do all the research and find the right company at the right price, you face the hardest part of all, just having the courage to hold on when everyone around you is panicking.
Fisher's argument here was just simple, cold, hard logic. He figured that with enough good scuttlebutt, you can be right about a company's long-term quality about 90% of the time. But try and guess which way the market's going to zig or zag tomorrow. He thought even the best of the best would be lucky to get that right 60% of the time. So why on earth would you trade a 9 out of 10 advantage for what's basically a coin flip? It makes no sense.
And believe me, this idea was about to be tested by fire. In 1962, one of his favorite holdings, Texas Instruments, a stock that had already been a massive winner for him, it didn't just fall, it cratered. It dropped a jaw-dropping 80% from its peak. Just stop and think about that. 80% of your money gone, on paper. Can you imagine the sheer terror? The pressure to just sell and make the pain stop must have been absolutely immense.
But holding on for Fisher didn't mean closing your eyes and praying. He told another story about a company that also crashed. In that case, he did sell, but not at the bottom. He said his mistake there wasn't holding, it was getting complacent. He had stopped doing his homework and had missed that the management team was no longer top-notch. So the real lesson is hold, but always, always verify.
And what about Texas Instruments? For those investors who had the stomach to endure that 80% nightmare, the reward was just incredible. Within a few years, the stock didn't just claw its way back. It blew past its old high and eventually traded for more than double its previous peak. That is the explosive power of owning a truly great business and having the patience to let it work.
So, what does this all mean when you put it together? When you take his wartime insights, his detective-like research, his painful but valuable mistakes, and his incredible courage, you end up with a clear, powerful framework for investing that's just as potent today as it was 70 years ago.
So here it is, the whole thing in a nutshell. You start with obsessive, scuttlebutt research to find great companies that can grow for years and years. You have to be disciplined and not overpay. Once you're in, you need the guts to hold on through the crazy ups and downs, always remembering that your mistakes are your best teachers. And finally, you look for companies that take their profits and plow them right back into the business to grow even bigger, not just hand them out as dividends. That's the real engine of compounding wealth.
Which really brings us to the big question for today. We live in a world of constant news, algorithms trading in microseconds, and this obsession with what's going to happen in the next 3 months. In an environment like this, is Philip Fisher's slow, patient, deeply thoughtful approach, is it just a relic? Or is it maybe more valuable, more essential than it has ever been? Definitely something to think about.
There's this huge, cornerstone theory in modern finance, one that's taught in every business school. But what if I told you it was basically a myth? What if the stock market isn't this perfectly rational, all-knowing machine, but is actually a place just packed with human emotion? And because of that, it's filled with opportunities for anyone who's willing to think just a little bit differently. Well, today, we're diving into the mind of a true legend, Philip Fisher, a guy who built an absolute fortune by betting against the crowd.
Okay, so here's the game plan. We're going to start by tackling the very theory that Fisher famously tore apart. Then, we'll dig into the actual data he used to prove his point. And this is the fun part. We're going to look at a real-world case study, a company called Raychem, to see his philosophy in action. And then, we'll wrap it all up by unpacking his 8 core principles for investing, which are, let me tell you, as relevant today as they ever were.
All right, first things first. Before we can understand Fisher's genius, we have to understand what he was up against. We have to get to know the dominant theory on Wall Street, the one Fisher saw as just a massive money-losing trap.
And here it is, the efficient market hypothesis. The basic idea is that at any given moment, a stock's price already reflects every single piece of available information. All the earnings reports, all the news, all the analyst ratings, it's all baked right into the price. So, according to this theory, trying to find an undervalued stock, a bargain, is a total waste of time. It suggests that unless you're trading on illegal inside information, you just can't consistently beat the market.
But Philip Fisher, who had spent a half-century actually investing real money in the real world, he just wasn't buying it. He thought the theory was, well, a complete fallacy. To him, it was a neat academic idea that completely fell apart when it met the messy, emotional reality of the stock market. For Fisher, the market's imperfections weren't a problem. They were the entire source of the opportunity.
That's a pretty bold claim, right? To stand up and say that generations of financial academics are just plain wrong. You can't do that with just a hunch. You've got to bring the evidence. And believe me, Philip Fisher brought the receipts. So let's step into Philip Fisher's classroom at Stanford's Graduate School of Business. He ran a really simple but incredibly powerful experiment with his students that basically blew a hole right through the side of the efficient market theory. The setup couldn't have been more straightforward. He had his students randomly pick 140 stocks from the New York Stock Exchange. Then they just tracked them. They watched them for almost 5 years straight. And during this period, the overall market, measured by the Dow Jones, did pretty well. It was up a very respectable 41%.
Now here is where it gets absolutely fascinating. Look at this chart. If the market were truly efficient, you'd expect almost all of these stocks to be clustered right around that 41% average gain. But they're not. I mean, they're not even close. They are scattered all over the map. More than a quarter of them, 27%, actually lost money. And on the flip side, you had a whole bunch of them, 24%, that just went to the moon, gaining over 100%. This is just not what an efficient market is supposed to look like.
And this is where it gets personal. Let's put some real money on the line. Fisher showed that if you had just gotten lucky and put $10,000 into the 5 best-performing stocks from that random list, you would have turned it into more than $70,000. But if you had the terrible luck to pick the 5 worst stocks, that same $10,000 would have shriveled down to just over $3,000. The difference is staggering.
So, what's the big takeaway here? It's that your choices, the specific stocks you pick, matter. They matter immensely. We're not talking about a small edge here. The potential difference between a wise investment and an unwise one was nearly $50,000. This simple experiment just hammers home the point. Stock selection is not a waste of time. It's the whole ballgame.
Okay, so the numbers are pretty compelling, but nothing brings a theory to life like a good story. So let's jump in our time machine and go back to the 1970s to look at the incredible story of a company called Raychem. It's a perfect example of how market panic can create the opportunity of a lifetime.
Back in the mid-70s, Raychem was an absolute darling of Wall Street. And you can see why. This was a company that was built like a fortress. They had this amazing business philosophy: only tackle the really hard technical problems, control everything from the initial idea all the way to the final customer, protect everything with patents, and only get into a market if you think you can be number one. I mean, this was a company designed to dominate. But, as we know, things can change in a hurry. At its peak, Raychem was trading at over $42 a share. Investors couldn't get enough. Then, in 1976, bam, the floor fell out. The company was hit with two massive hammer blows: a high-profile product that completely failed, and a very expensive, very painful corporate restructuring. The market didn't wait around to ask questions, it just panicked. And the stock price collapsed, falling all the way to around $14. 2/3 of its value just gone.
This quote from Raychem's management about their big project, Stillin, really says it all. The product was an engineering marvel. Scientifically, it was incredible. But from a business perspective, it was a total dud. A competitor came out with a cheaper product that was just good enough, and it killed them. This kind of brutal honesty from management was one of the things that sent investors running for the hills.
So that was blow number one. The second blow was that costly management restructure. To the average investor, this looked like another disaster: more chaos, more uncertainty. But this is where Philip Fisher's different way of thinking kicks in. He looked at that same restructuring and saw something completely different. He saw a brave management team making the hard, necessary decisions to set the company up for future growth. While the crowd was seeing a five-alarm fire, Fisher saw a controlled burn that was clearing the way for new life.
And here it is, the smoking gun that proves the market's inefficiency. In early 1978, Raychem's leadership held this marathon meeting where they laid everything bare. They talked about all their mistakes, all their problems, but also their detailed plan to fix it. And what did the market do? Absolutely nothing. For weeks, the stock price just sat there, dead in the water. Investors were so scarred by the bad news that they were completely blind to the good news that was staring them right in the face. And that, right there, was the massive, glaringly obvious opportunity.
So, if we accept that the market is this chaotic, emotional place, how on earth are we supposed to navigate it? Well, Philip Fisher didn't just diagnose the problem, he gave us the cure. He laid out a clear framework, 8 core principles that can help an investor turn all that market madness into a real advantage.
Let's start with the first 4. Number 1, find great companies. Companies that have a real, disciplined plan for long-term growth. Number 2, and this is key, buy those great companies when nobody else wants them, when they're out of favor for some temporary reason. Think Raychem after its crash. Number 3, once you buy, hold on. Be patient. Don't sell unless something fundamental about the company has actually changed for the worse. And number 4, don't get distracted by dividends. The real money, the life-changing money, is made from capital growth, not from small, regular payouts.
Okay, the next 4 principles are really about your own mindset. Number 5, be tough on yourself. When you make a mistake, admit it. Cut your losses and move on. But when you get it right, let your winners run. Number 6, don't be afraid to make big bets. When you find a truly great idea, concentrate your money there. Number 7, you have to develop the courage to go against the herd. And finally, number 8, there are no shortcuts. Success comes from good old-fashioned hard work, intelligence, and being honest with yourself.
I want to pause on that 6th point for a second because it's so important and so contrarian. Fisher basically thought that wide diversification, owning tons of different stocks, was a sign that you didn't know what you were doing. He was a huge believer in concentration. He said the average person should probably only own about 10 or 12 stocks. Find your absolute best ideas and put your money behind them with conviction. That's how you build real wealth.
So we've looked at the theory, the data, the story, and the principles. It all really boils down to one final, incredibly powerful idea. This is the very essence of what made Philip Fisher so successful.
This quote says it all. This is the heart of the entire philosophy. It's a 2-part process. First, you have to do the work. You have to gain more knowledge and develop better judgment than the average person. But that's only half the battle. The second part is having the moral courage, the guts, to actually act on that knowledge, especially when it means going directly against popular opinion.
You know, Fisher loved this old French saying, the more things change, the more they stay the same. And for him, this applied perfectly to the stock market. Technology changes, economies change, companies change, but human psychology, that's the one constant. The same waves of fear and greed that created opportunities in Fisher's day are still creating those same opportunities right now, today.
And so, that's the final question I want to leave you with. The next time you're thinking about buying or selling a stock, just stop and ask yourself this one simple question. Am I doing this because I'm following the crowd, or am I doing this because of my own hard work and my own deep conviction? The answer to that question will make all the difference.